Steen, would you like to share your slides, your screen, and then I will start just to make sure that everything works. Okay.
See it okay?
Yes, excellent. So it's 2 o'clock London time, and we have the second day of the conference starting. Our speaker today will be Steen van Nieuwenburg. He's going to present his work with Jiang, Lustig, and Zhao Lan, and on the US debt output ratio. So you have 35 minutes. I will give you a warning when you have only 5 minutes left, just in case you run out of time. Okay. Thank you very much, Steen.
Thank you.
The floor is
yours.
Thank
you, Tassos. Thanks so much for having me, and thank you for organizing this wonderful conference. Apologies to the presenters yesterday that I could not attend. I was ironically flying back from England to the US, but looking forward to the papers today. So this is a paper called "What Drives Variation in the U.S. Debt to Output Ratio: The Dogs That Didn't Bark," with my co-authors that Tassos just mentioned. So this paper, just like the entire conference, I'm sure is framed by this large rise in government debt that we've seen all over the world, in particular also in the United States, and this debt is projected to keep going up according to the Congressional Budget Office. So what we want to do today is think about this question of fiscal sustainability and take a forward-looking approach. And as I'll show you momentarily, the approach we're going to take essentially suggests that the current increase in the U.S. debt to output ratio could reflect one of three things, or some combination of these three ingredients: either lower future expected returns on government debt, and these are inflation and growth adjusted returns, or higher expected future surpluses, or a higher future debt to output ratio. Okay. And so what we're going to do is we're going to take a standard asset pricing Campbell-Schiller approach to this macro question of fiscal sustainability to show that it's neither of these first two candidates. So it's not future returns that are adjusting, and nor is it future cash flows, future surpluses. Instead, what the data suggests is that today's higher debt to output ratio today signals a higher debt to output ratio 5-10 years from now. And so one way of interpreting this finding is that essentially there's excess smoothness when it comes to the government bond portfolio. Bond prices on federal government debt are not responsive to news about future macroeconomic fundamentals, be it future cash flows, future surpluses, or future discount rates, future growth and inflation adjusted returns. So that finding is actually a little bit different. So people have studied this question in the past, kind of using similar approaches. And our findings are actually a little different from the literature. One classic paper is the paper by Bohn in '98. He looks at this question with a sample that ends in the mid-1990s and finds evidence that a higher debt to GDP ratio, predicts higher future primary surpluses. We're going to revisit that evidence. Cochrane also studies this question and finds that a higher debt to output ratio predicts lower nominal returns on government debt. Okay, we're going to be interested in real growth adjusted returns. And so one of the reasons our findings differ is because it turns out there's an important statistical problem with a lot of the prior empirical evidence, which is that, and this is a problem that is very well known in asset pricing, there is essentially a large small sample bias in these predictability coefficients. And I'm going to briefly revisit that, but basically this bias comes about whenever you have a prediction problem where the predictor is very persistent. So here our predictor is going to be the debt to output ratio, and it is indeed very persistent. And when you have a high correlation between the innovations to the predictor and the innovations to the objects that you are predicting, okay, in our case, surpluses or future bond returns. And in fact, we're going to have both of these conditions met. And so we'll show there's a very large small sample bias, which leads one to overstate predictability relative to the true predictability. Okay, so I'm going to skip this to a large extent, but basically our paper is going to connect to the literatures on stock and bond return predictability. Unlike the bond return predictability, will not be, so in finance, the bond return predictability is all about predicting individual bonds. I want to predict the returns on investing in a 5-year treasury bonds. So instead, our focus is on the entire government bond portfolio. Basically an investment strategy, if you like, that invests in all the bonds that the government issues and participates in all the redemptions of those bonds. Okay, we also connect naturally to the literature on statistical issues with persistent predictors. both in macro and in finance. And then, of course, with the work that all of you are doing on fiscal policy and budget constraints. So, just very briefly. So here's the outline for the rest of my 30 minutes. I'm going to tell you a little bit about the implementation of this Campbell-Schiller approach, and then I'll show you the main results first without, and then with a small sample bias adjustment. So the result from that will be that it's going to look like the debt to output ratio is it's very hard to reject the null hypothesis that the debt to output ratio follows a unit root process. And so to bolster the case for the unit root process, I'm going to simulate under the null of a unit root, and then show that what I get looks exactly like the data. And then I'm going to take a step back and ask, what are some of the economic drivers that impute this very persistent, this unit root process into the debt to GDP ratio. I'm going to think about two potential candidate explanations for that. One is the holdings of the Fed and the rest of the world. And another one is to think about subjective beliefs in forecasts. Okay, and both of these are candidate explanations for why there might be such a persistent component into the debt to GDP ratio. Okay, so let's get into it. So our starting point is essentially the government budget constraint. And you can write the government budget constraint in this equation at the top of the page here. So this is essentially a log linearized government budget constraint, following the exact same approach that Cochrane has taken in his recent paper. And so basically what you're looking at here is VT is the log debt to output ratio. VT plus 1 is the log debt to output ratio next period. S is the surplus. It's actually the surplus to GDP ratio, which is scaled. And then R tilde, is what I'm going to call the inflation and growth adjusted return. So it's the return on the nominal return on the government bond portfolio minus inflation minus real GDP growth. Okay, and so this R tilde is this real growth adjusted return on the government portfolio. And so by the government budget constraint, this is an accounting identity that must equal essentially the change in the debt to GDP ratio plus the surplus. Okay, and so I just want to draw an analogy here. This looks very similar to what we do in asset pricing when we look at the return on stocks, which reflect the price, essentially the difference between the price dividend ratio between today and tomorrow plus dividend growth. Okay, and so what we're going to do is we're going to iterate forward on this equation, capital T times, so 10 years. Let's say capital T is 10. This is annual, 10 years. So then the debt to GDP, and then we're going to take expectations. Okay, and so what this tells us is that the debt to GDP ratio today equals the expected sum of all surpluses over the next 10 years minus all future returns, growth and inflation adjusted returns, plus this terminal term here, which is the debt to output ratio 10 years from now. Okay. So this rho is a linearization parameter. It's essentially, we're going to set it equal to 1, because think of this rho as basically linearizing around the point where R equals to G, R equal to G. So the interest rate is equal to the real rate of growth. Okay. So that's rho equal to 1. Okay, so we're going to set rho equal to 1. Our results are not sensitive to this assumption. We do some robustness around different linearization points. And under this assumption of rho equal to 1, this becomes even simpler. The debt to GDP ratio is literally the sum of these expected future surpluses minus expected future returns over the next capital T years, plus the expectation of the debt to GDP ratio T years hence. Okay, and so now you can take variances or you can multiply the left and the right hand side by the debt to GDP ratio today, and then just take the variance. And so basically you get that variation in the debt to GDP ratio must reflect either covariation of the debt to GDP ratio with future surpluses or covariation of the debt to GDP ratio with future real growth adjusted returns, or covariation of the debt to GDP ratio today with the debt to GDP ratio 10 years from now, okay, if T is 10. And so basically what you can do is you can easily calculate these three terms and do this variance decomposition. How do you do it? You run a simple system of linear predictability regressions where you regress future surpluses on the lagged debt to GDP ratio, future returns on the lagged debt to GDP ratio, and you have an autoregressive process for the debt to GDP ratio itself. Okay, so you could think of this as like local projections, if you like. Okay, and this is, a standard approach. People have done this in when predicting dividend growth on stocks and returns on stocks. It's basically the same idea here, but applied to cash flows. The cash flows here are the surpluses. The returns are these real growth adjusted returns on the government bond portfolio, and our predictor is the debt to GDP ratio. Okay, and so I want to define fiscal sustainability as basically a situation where this autoregressive parameter phi is less than 1 for each horizon capital T, and tends to 0 as capital T goes to infinity. Okay. So basically, this is a system of equations. You can just literally run these 3 linear regressions, and there's a cross equation restriction between these 3 coefficients of these 3 regressions. They basically have to sum to 1. Okay, if we define this one here with a negative sign. Okay, and so basically when you run these regressions, you automatically get the shares of the variances in the debt to GDP ratio that is accounted for by each of these 3 terms. And because they're shares, they have to sum to 100%. So, that's what we're going to do. Let me first show you some data before I show you the results from this decomposition. Right, so here I'm just reporting some basic summary statistics for US data, and I'm showing you some decadal averages. Right, so here's nominal returns on the government bond portfolio, real GDP growth, inflation, and then R tilde, which is this real and growth adjusted return. Right, it's basically this column minus this column minus this column. Right, and interestingly, I want to just briefly, it's a bit of an aside, but briefly point out that the evidence that R is less than G, right, or in my notation, R tilde is negative, is concentrated in the first half of the post-war sample. It's actually not the case in the second half of the post-war sample. And I also want to point out that surpluses came down over time. Right? Surpluses were on average positive 0.8% of GDP in the first 30 years of the sample, turned negative in the last 30 years of the sample. Okay, and so what we want to understand is to what extent the debt to GDP ratio can help us understand this kind of slow-moving decadal type of variation in these returns or in the surpluses. Right? Can we learn anything about dynamics in the debt to GDP ratio that is informative about future returns or about future surpluses? So we're going to do our standard Campbell-Schiller decomposition by as I explained, running the system of regressions. And we can do this for different horizons. So this is this capital T. We go from 1 to 10 years, right? And if you basically look, for example, at the 5-year horizon, what this is telling you is that 83% of the variation in today's debt to GDP ratio is accounted for by variation in the debt to GDP ratio 5 years from now. 9% is accounted for by variation in future surpluses, and 8% by variation in future returns. Okay, so the vast majority of it is the debt to GDP ratio today tells you about the debt to GDP ratio in the future. At the 10-year horizon, however, we're starting to see a lot more surplus predictability, 39% of the variation, and a lot more, and also more return predictability. Okay, and so from this, and as a result of that, less predictability of future debt to GDP ratio. Okay, but we're going to argue that these point estimates are actually misleading, and we'll come back to this in a second. Okay, so here's that same evidence graphically. I'm basically, again, reporting the share of the variance, these coefficients for regressions from 1 to 10-year horizons. And you can see kind of this line goes to almost 50%, right? By the end of, by horizon 10, nearly half of the variation in the debt to GDP ratio appears to be accounted for by a variation in future surpluses. A little bit is accounted for by future returns. And then the rest of it is accounted for by future debt to GDP ratios. Okay, so I'm going to show you some pictures where I sometimes call S and R, I call those the fundamentals. Okay, and so I'm going to sometimes combine these fundamentals and basically kind of contrast how much of the variation is accounted for by fundamentals, either future surpluses or future returns, versus accounted for by variation in the future debt to GDP ratio. Okay, so kind of the key observation in our paper is going to be that these regressions are problematic from a statistical point of view, and the reason is essentially what's known in asset pricing as the Stambaugh bias, and it's essentially a small sample bias. When two conditions are satisfied, one, the predictor is very persistent, and two, there is a negative correlation between the innovations to the predictor and the innovations to the predicted variables. Okay, and that's exactly the situation we have here. And so there's a well-known solution to this, which is you can bias adjust your coefficients, because you can calculate the size of the small sample bias and then adjust your OLS coefficients to essentially bias correct them, right? And so here's some expressions for the size of the bias. As you can see, the size of the bias is going to depend on the persistence. So remember, this phi parameter is the persistence of the debt to GDP ratio. That's about 0.99 in the sample, so that's very close to 1. And it depends crucially on these covariances here between the innovations in the debt to GDP ratio, that's your predictor, and the innovations to the variable that you're predicting, either returns or surpluses. And it turns out in our setting, both of these are very strongly negatively correlated. And there's just a very good economic reasons for this. For example, when the surplus is low, the government needs to issue more debt. So you get this natural negative correlation between surpluses and debt. Similarly with the returns, if there's an increase in the bond risk premium that lowers the market value of government debt, that also that also increases the return, the future realized returns on the debt. So you get very good economic reasons for why to expect this strong negative correlation. Okay, so basically what we'll do is we'll calculate this bias and we'll bias adjust our coefficients. Okay, and so here's what the bias adjusted predictability tells us, right? So this is to be contrasted with this graph here, where we found that at horizons of 10 years, we got almost 50% of the variation in the debt to GDP ratio driven by future surpluses, 25% by future returns. Once we bias correct, almost all of it disappears. We get essentially 0% of the variance accounted for by future surpluses, approximately 0% by future returns. So combining these fundamentals, they account for almost none of the variation in the debt to GDP ratio, which means that almost all of it has to be accounted for by the variation in the future debt to GDP ratio. Okay. And so if you want to see this in numbers, here's that same table I showed you before, but now with the bias adjusted coefficients in blue in the bottom row. And again, the point being that at horizons as far out as 10 years, you get essentially all of the you cannot reject the null hypothesis that all of the variation is accounted for by the future debt to GDP ratio, and none of it is accounted for by future surpluses. So, one of the problems or issues with this type of analysis is that even though this evidence, the point estimates are very clear, there's still substantial standard errors around these point estimates, right? So it's always hard. It's well known in statistics. It's always hard to, it may be hard to reject the null of a unit root, but it may also be hard to prove that there is a unit root. Right? Another way of saying that is that there's still substantial standard errors around, in particular, the surplus predictability coefficient. If you look at the standard error bands here, they're still quite wide, right? Less so for returns. I think for returns, it's a stronger case that there's no return predictability, but for surpluses, it's still hard to reject that there's no surplus predictability. And so, one thought is, can we, look at more data and a longer sample and revisit this exercise? And so we look at the sample that Tom and George and Payne have used, which goes back all the way to 1842. And basically we find the same finding. We find evidence, that there seems to be some surplus and or return predictability, but once you do the bias adjustment, these estimates go substantially down. And we actually now have more power to reject the null of no predictability because we have more data. We also revisit the Bone 98 paper, which uses a sample that starts in 1948 and ends in 1995. And that bone sample actually argues that there's strong especially surplus predictability. I'm showing you here surplus and return predictability combined, but almost all of it is coming from surplus predictability. And we can recover these estimates from Bone. So we agree with his point estimates from these OLS regressions. But again, there's a strong small sample bias. Once you adjust for that small sample bias, nearly all of the predictability goes away. Okay, and again, you end up with a very similar conclusion, maybe a little bit less strong as in the sample that goes until 2020, that most of the variation is coming from future debt to GDP ratios. So to bolster this, so I think the evidence I've shown you so far, I think is consistent with a unit root in the debt to output ratio. And so to kind of bolster this potential explanation, what we do is we're going to simulate under the null hypothesis that there in fact there is a unit root in the debt to output ratio, and then try to show you that this small sample bias correction that we've been doing is actually accurate in sample. So the way we're going to go about this is we're going to write down a process for the debt to GDP ratio, which is a unit root process. We're going to model the innovations to that unit root process as an AR1. And then we're going to assume that returns are not predictable. Okay, so they're IID. And so we're going to join, and so basically by assumption, we're constructing a set of data here where there is neither return nor surplus predictability. Okay, so we're going to estimate these innovations in historical data, and then we'll do basically a bootstrap exercise where we're going to draw with replacement from these historical observations, and we'll draw time series of the same length as the data, and we'll do that 10,000 times. And then we'll re-estimate our return and surplus predictability equations on these simulated data. Okay, and that's going to allow us to evaluate the accuracy of this small sample bias correction. Okay, so when you do this, and you run these 10,000 regressions from a model where in fact there is no surplus predictability and there is no return predictability by assumption, you're getting essentially the red line is your mean estimate among these 10,000 simulations, and then the gray areas are again your 1 and 2 standard deviation standard error bands. And basically, the red line looks essentially exactly like the OLS data that I've shown you, the non-adjusted, the non-bias adjusted data. In fact, not just qualitatively, but also quantitatively, right? So basically, you're finding that there's about 50% of the variation in the surplus, in the debt to GDP ratio is accounted for by future surpluses, just like in the data, with wide standard errors around it. Less of it is accounted for by returns with smaller standard errors around it, just like we found in the data, and all of it is spurious by assumption. Okay, so the blue line is the truth. That's the null that we simulated under. And so basically, I think this provides strong evidence that you can easily find this kind of spurious evidence in small samples for surplus and return predictability. And it also shows that the small sample bias adjustment that we've applied is actually of the correct magnitude. So what that suggests is that there's kind of this strong persistent component in the debt to GDP ratio, essentially something that seems very hard to distinguish from a unit root. And so we're going to kind of think about that process a little bit more, about that persistent component, right? And so one thing you could do is you could ask, is there a structural break in the debt to output ratio? And in fact, when you do a structural break test for a structural break in the debt to GDP ratio, you in fact find that there is one break in 2007. And essentially, the size of the break is about 78 percentage points. So the mean of the debt to GDP ratio is 78 percentage points lower in the subsample before 2007 than in the subsample after 2007. And following an idea that I explored in an earlier paper in the stock market, you can essentially create a demeaned debt to GDP ratio, this V tilde here, which takes out the different subsample means out of these two different subsamples before and after the break. Okay, and so what that creates is essentially a transitory component of the debt to output ratio. We've taken out the structural break, we've removed essentially a very persistent component out of the debt to GDP ratio. What remains is something that is much more transitory. And with this transitory component, you can revisit the Campbell-Schiller decomposition. And what you find now is that there's more evidence for surplus and return predictability. This transitory component of debt to GDP ratio, that one actually does a better job forecasting future surpluses and future returns than the entire debt to GDP ratio. In part because we've removed this kind of very persistent component, this structural break. And in part also because the resulting transitory series is a lot less persistent, almost by construction, and so the standby bias is much less of an issue. The small sample bias is much less of an issue. So then, that raises the question: if indeed there is kind of this structural break in the debt to GDP ratio, what caused, or what is the economics behind that structural break? And so one candidate explanation for this structural break is holdings of government bonds of US Treasuries by the Fed as part of its quantitative easing program and by foreigners. Think of the Chinese central bank or the Japanese central bank. And in fact, if you look at those holdings indeed accelerate quite rapidly. What I'm plotting here is total debt to output, and then debt to output that removes the Fed and the rest of the world. Okay, so you can think of the dashed line as the holdings of government bonds by US domestic private sector agents. And so you could think of this dashed line as maybe a candidate transitory component in the debt to GDP ratio. By removing the foreigners and removing the Fed, I've kind of removed that kind of structural break in the debt to GDP ratio. And the timing of it also lines up well, because after 2007 and the great financial crisis, the QE program really ramped up. Okay, and so in fact, we show that if you use that that foreign and that ex-Fed and ex-foreign debt to GDP series, in fact, you again find you recover more surplus predictability and you recover more return predictability. A second candidate explanation for this structural break in the debt to GDP ratio that we explore is an idea of there being biased beliefs, right? So the idea is the following. The econometrician who looks at this data, as I've shown you, does not predict higher surpluses or lower returns when the debt to output ratio rises. But that doesn't mean that bond investors may not be predicting these higher future surpluses or future returns. So bond investors may simply be wrong. They may have, misspecified beliefs in the sense that, they are systematically over-predicting surpluses and under-predicting bond returns when the debt to output ratio increases, right? If that's the case, then their forecast error can impute a unit root in the debt to output ratio. Okay, so we're going to explore this idea. So you can think of the debt to GDP ratio as either reflecting expected future fundamentals plus expected future, fundamentals plus expected future debt under the true probability measure, or under the subjective probability measure, which I'm going to denote by this F. Okay. And so then you can rewrite this and you can say, well, the debt to GDP ratio reflects the true expectation plus the subjective expectation of the debt to GDP ratio of the bond investor plus this forecast error term. And this is the forecast error that these bond investors are making about, let's say, the next 10 years of surpluses and returns. And so what you can now find is that you can actually find that this covariance between debt to GDP ratio and the true expectation of future debt is large, and that the covariance of this debt to GDP ratio with these subjective expectations of the debt to GDP ratio is small, if and only if the covariance of the debt to GDP ratio with this forecast error is large. Okay, and so that's this idea that I was highlighting here, which is this idea that if the debt to GDP ratio goes up, if the forecast errors get large about future surpluses, for example, in the sense that bond investors are over predicting how much future surpluses the government is going to run, then that can impute essentially a unit root in the debt to output ratio. Okay. And so we want to provide some empirical evidence that suggests that this might be going on. And we're going to do this by looking at the CBO projections of future surpluses and also debt to output. So the CBO has kind of essentially every year, it kind of gives you 10 years worth of future surplus projections. Just to be clear, it does this under current law. It's not like the CBO is trying to do its best modeling what future tax policy is going to look like. It is basically taking tax policy and spending policy as given and basically making forecasts about GDP and inflation and interest rates and under current fiscal policy that leads it to predict future surpluses. And so each of these lines here with different colors is one of these vintages of 10 years worth of predictions for the future surplus, right? So at each point in time, and the black line is the actual realized surplus that happened. And if you look at this graph here on the right side, what you notice is that all the colored lines are above the black line, which means that essentially over the last 10 years, even more over the last 15 years, the CBO has consistently, over-predicted future surpluses, right? And in particular, whenever the debt rises, it tends to over-predict future surpluses. So it tends to assume that, fiscal policy will get corrected and the government will start running surpluses every time the debt increases, right? And that leads it similarly, as shown in the left panel, to consistently under-predict future debt to output, right? And so the argument we're making here is that if private forecasters, if bond investors are using these similar type of projections as the CBO, and we have some reason to believe that they might, because we've looked at some private forecasts from consensus economics, and they actually line up quite closely with the CBO forecasts. We can only do that for one-year forecasts, which is why we have to rely on the CBO for these 10-year forecasts, because there's only one-year forecasts available from the private sector forecasters. But basically, they align very closely. So under this assumption, essentially we get this condition that indeed the forecast errors are large every time the debt to GDP ratio increases. So this covariance is positive. So this is another reason how, this is another channel through which there could be this persistent component imputed into the debt to GDP ratio. So let me just wrap up.
You have 5 more minutes. But you're doing pretty well.
I'll yield my time to Rafat and to the floor.
I'm happy to take that.
Okay.
So what I've argued is that, what we argued in this paper is that US bond market valuations are surprisingly insensitive to news about future surpluses or returns. This actually stands in sharp contrast with what we find in the stock market. In the stock market, Schiller, got a Nobel Prize for this idea of excess volatility, right? Which is that, stock prices seem to be moving more than fundamentals, more than cash flows. Well, for the entire government bond portfolio, we find exactly the opposite. And so what that kind of leads us to is to, basically a conclusion, and it's hard to reject the null hypothesis that there's a unit root in the debt to output. And that conclusion is definitely bolstered once small sample bias issues in our standard predictability regressions are corrected, are addressed. And so in terms of the economics, I think, why is there such a persistent component in the debt to output ratio, or even a permanent component in the debt to output ratio? It could potentially, and I think that connects to this finding of a structural break in the debt to GDP ratio before versus after 2007, could potentially be the Fed and rest of the world purchases, or it could potentially be bond market investors whose overly optimistic beliefs about future fiscal rectitude are imputing a persistent component into the debt to GDP ratio. Thank you so much. Looking forward to Rafat's comments.
Thank you very much, Tim. Our discussant is Rafat Gürkaynak from Bilkent University. Rafat, can you share your screen? Excellent. So
very good. Thank you, and excellent pronunciation of my surname. I commend you for that. Well, now that I have 5 extra minutes, I can leave you with this title screen for a minute and tell you that this really is a paper worth reading. It's fascinating in many ways, although I'm going to complain about it because, where is the fun in discussing a paper if one isn't going to do this? But the issue here is something that we rarely think of in the context of the US, right? It's debt sustainability. Usually this is a emerging markets something, right? And of course the big issue here is, in fact, this is a nice question for Stein. Now that you've done this, are you worried that the US is going to default on the debt that you're holding? I doubt that's the case, right? I mean, somehow it doesn't have the same sense of urgency, immediacy, or gloom that one would have had this been an emerging market economy, right? For a variety of reasons that we kind of understand well. In particular, borrowing in your own currency kind of helps. But there is a connection between this and all this literature about international capital flows and emerging market debts and exorbitant privilege that is waiting to be developed. Now, okay, so this is going to be, I'm going to start by praise, of which there is a lot for this paper. I'm going to be very short of talking about what the paper does, because one of the praises is very clearly written, and people write papers so clearly, often, as is the case here, present as clearly, so I knew this wouldn't be needed. A couple of suggestions, why don't you look at this, some of them easy, some of them not so much. And then is going to be my main complaint that, I can say this already, the paper gets a lot of mileage out of essentially essentially what is a definition, an identity, right? And I have a lot of respect for this because you don't get to quibble with identities. On the other hand, you can't base theories on identities either. So it really is quite silent on, okay, so why is this happening, right? What should I make of this? Should I really be worried? And I very much welcome a bit more theorizing about these questions. Okay, so that's the first thing. The return, the growth adjusted real return, is a definition, right? Debt to GDP is also a definition, and their dynamics come from these definitions. So it's not like this is a theory of debt to GDP. It really is the definition of debt to GDP. And you don't get to say, well, why this definition or some other? It has to be this. So it's wonderful that you're able to play with this and get so much mileage out of it. You may think of this along the lines of, well, in the olden days when we had just come up with the definition of GDP by production, right? Somebody comes along and says, well, by definition, this has to add up to C plus I plus G plus net exports. Let me show you that decomposition, right? So when you see this, it's eye-opening. On the other hand, if you want to think of this in terms of, okay, so I want to increase GDP, or I'm worried about where GDP is going, it's still the same definition, and you can't use this as policy advice, right? But extremely clear paper and very well done, and the statistical work is truly commendable, right? Thinking properly about the small sample bias, how to fix that, how to think about the structural break. These are just really beautiful and exemplary paper on how to write a decent, good empirical paper. Okay, so what it does really is that it says, let's use the definitions on return on government debt and debt to GDP, and think of this as a decomposition, essentially into, look, if I see debt to GDP going up today, it really has to be either that we're going to have surpluses tomorrow, or we're going to have lower returns tomorrow, or debt to GDP is going to remain elevated tomorrow. Okay, again, can't argue with that. But, and again, this is not something new. Not even for bonds, this isn't terribly new. But the way it's implemented here is new, that the literature so far has thought of thinking of these decompositions in a backward-looking way. Here, there are these forecasting regressions that says, okay, on the right-hand side, we actually have to have the future surplus, the future return, right? And those things I'm going to forecast and look at how well they help me understand today's debt to GDP, right? Okay, so what you find is really it's all in that residual item. It's all in the, if debt to GDP is high tomorrow, well, this is sustained by the expectation that's going to remain elevated tomorrow. Okay, and in many contexts, I guess that's a scary thought, right? This isn't how we were brought up. If you have debt today, some intertemporal budget constraint tells you that you better have surpluses, or maybe not, right? This is exactly where you need theory, because sovereign states tend to be very long-lived, right? And perhaps 10 years is way too short. Perhaps what I want to think of, in fact, what I do want to think of is it conceivable that if push comes to shove, the US will be able to pay back this debt if we all refuse to roll over the debt tomorrow, right? And the answer is most likely yes-ish. If it's really that we all refuse to roll over the debt tomorrow, it's going to be a not small problem. But does the US have the capacity to raise funds to pay back the debt, right? Probably the answer is yes, and I'm going to have some bets there. Okay, so the suggestions are this. The structural break is nice. On the other hand, it also muddies the waters, right? So there's much reason to think of, and the paper is very clear that there is one structural break in 2007 and nowhere else, right? So rather than fixing the structural break, have a sample that ends in 2007 and tell me that, yeah, the results actually are either the same or different. And they are probably going to be the same because you do this for a sample that ends in 1995 already. That's the bone sample, right? and you find that the same unit root is still there. So this unit rootness, it feels, isn't driven by the structural break that is not taken into account. But if that's the case, then the point here is it can't be this, global financial crisis driven increase in foreign central banks' appetite or the Fed's QE or things of this sort, that the same structural break was there already, right? The other question here is, it's natural that these things start with an application to the US, but the US isn't really the most interesting advanced economy to look at, right? So you'd like to look at, for example, Japan, right? If you're worried about the trajectory of debt to GDP in the US, I can also always tell you that, well, there's Japan that has, more than twice as much debt to GDP, right? Or I think this is the really interesting one, right? Think of the countries that were involved in the European debt crisis and ask, did they look like the US today before they ran into their debt crises, right? And of course, if you look at the full sample, these countries will appear to have generated the surpluses because they had to, right? They were pushed into austerity, they generated surpluses. So in a post sample or in a full sample, they're going to look like countries that were able to generate surpluses, and thus debt to GDP, say in 2005, was explained by surpluses in 2013-14. But we know that this wasn't by choice, that they were forced into it, right? So it would be very interesting, at least for me, to see what these countries look like before they hit the wall. Okay. The other bit is this negative returns that you show, right? You have these negative real returns, growth adjusted, until 1980, right? Strongly so, and then you begin to have these positive returns. Now, it's likely that that's not a coincidence, right? Because until the 50s, until the Treasury Accord, the Fed was actively helping the Treasury have low interest rates. And then, it's hard to think of these today, but until the 80s, Regulation Q put a limit on the interest rates bank could offer. And that naturally permeated to other markets as well. Essentially, until the 80s, the US had this very strong financial repression that allowed the Treasury to get away with paying these negative real returns, right? So thinking a little bit about how much of these results are attributable to those regulations, I think would be very welcome. Now, my main problem here is I learned a lot, but I don't know what to do with what I learned from this paper, okay? Now, part of this is that, let me come back to this, but the issue here is on the upside, definitions are wonderful to work with because you don't get to fight with them. On the downside, you can't base theories on definitions, very much like the quantity theory of money, for example, right? It's a definition of velocity, and I can't work with it as a theory. Now, the paper has this undertone of this is a problem that we find this unit rule. This is a problem that it's not future surpluses that are justifying today's debt. It may be, but it's not very clear. That's exactly where one would need a theory. The language where the authors label future surpluses and future returns as fundamentals, I found that unhelpful. And Steen used this in the presentation too, because there are three things. You label two of them as fundamental. The third obviously is non-fundamental, and non-fundamental in our world is a pejorative. But it's not at all obvious for me that I should equate this with something like a bubble, for example. Again, these are the places where one would need theory, because imagine that the US is very much under what would normally be a debt ceiling. Okay, this is not the legal debt ceiling. This is the market's willingness to lend to the US government. Okay, if you are below that, then it really doesn't matter whether you are paying off debt, borrowing more, borrowing less, whatever, right? If I'm a firm with a credit line and I'm way below the credit line, and the econometrician observes me as, I borrow and then I pay some of it, I don't, I borrow, I keep on rolling over things, right? It appears that I'm a firm that is never paying off debt. But the issue here is the lender understands that my debt repayment capacity is much higher than my existing debt, and therefore is willing to let me roll over indefinitely as much as I want, right? And in fact, increase my borrowing because the firm is much more valuable than the debt out there, right? So these are the things I think one needs to think about. And it doesn't have to be in this paper, right? The paper has a very clear question. How do I do the decomposition? But then this value judgments of fundamental, non-fundamental, it's a problem, sustainability, whatnot gets in there. And this isn't a framework to answer those questions. So I'd be much happier if the authors either brought in theory to talk about properly sustainability, fundamentalness, right? And substantiated these things, or stripped that out and said, you know, these are the stylized facts, and these are the things over which we have to theorize. Okay, and so.
And I thought you have to wrap it up soon.
Very good. Right. Okay. I already said these things, but again, the question comes to, you know, now that I learned this, should I think of this as a policy recommendation? Should I think of this as a bond portfolio recommendation? Those require theory, not something more than a definition. Okay, and part of this is that even in the U.S. history, this is a peso problem, in my opinion, in that unless you are forced to provide surpluses, governments prefer not to do that. In the US, and you know, there was a very nice chart in the presentation on this, right? You see the debt to GDP go down 3 times, post-World War I, post-World War II, and then late 1990s. And that's what differentiates the sample to 2007 from the bond sample, that the post-1990s decline in debt to GDP would be in there. This is the Clinton surpluses. And we really have to remember that it happened, it could happen, it did happen. In early 2000, the Fed's major problem was having to think about how to do open market operations in a world where all of the treasury debt would have been paid, right? And agencies were trying to substitute themselves for the treasury market. It's now difficult to imagine that that happened, but it was there. So in a sense, we understand that the US is able to generate surpluses. The moment that I say the US is able to generate surpluses, does it actually have to generate the surpluses for the debt to be sustainable? I think that's the big theory question, okay? I'll send you the slides. But again, if we are gonna think of this as a problem, then one has to ask, in all this, you know, 180-year sample that you look at and find a unit root, which is a problem for sustainability, how is it that the US has never defaulted, right? So perhaps the issue isn't that this is a sustainability problem. The decomposition is correct, but tying that to US debt sustainability requires a different kind of theory that is not in there. And so perhaps we should not be using this decomposition for that kind of language, okay? And again, if you extended the sample to today, you would have found massively negative real returns, which would, you know, make your decomposition happier. That, okay, now I'm explaining some of the high debt to GDP with negative returns that follows these things, right? And again, theory. So let me conclude with saying that this is a very nice paper. I have to tell you that I hadn't thought of the question, let alone the answer. So I learned a lot, and it's extremely well done. The statistics is truly exemplary. And what I would like to have is preferably these authors taking this as a establishment of very solid set of stylized facts and then theorizing over it so that it turns into policy advice, so it turns into things like whether that is sustainable, whether US debt management needs to change, and whatnot. Thank you.
Thank you, Rafet. Now we'll have Steen reply to your discussion, and then we'll have some questions from the audience. Let me remind you that there will be also a breakout room after the second paper, 2 breakout rooms, so that you can continue discussion and also from the audience have additional questions, right? So Steve, go ahead and then we'll take questions from the audience.
Thank you. I want to thank Refat for a very thoughtful discussion. I actually, just like he enjoyed reading the paper, I very much enjoyed listening to his discussion, and I agree with absolutely everything he said. I mean, many of these things we are pursuing in other papers. So let me kill two birds with one stone. So, and think about this peso explanation, for example, right? So I think you're absolutely right, Refat, that you can write down a model, and I have done so in a paper with Tim Landvoigt and Vadim Alenev, which is called "Can Monetary Policy Create Fiscal Capacity?", which is a fully structural model. So it's a theory, and it envisions a world where once the debt to GDP ratio becomes very high, the tax rates will go up. Okay, so it's exactly that peso explanation. You know, it's like it's an event we have not seen in 150 or 180 years. But once the debt to GDP ratio crosses that threshold, the model assumes that the government will start raising taxes. And in that model, you can get a decomposition of a Campbell-Schiller decomposition that looks not dissimilar from the one that I've presented here. So I think that is a theory for the facts in this paper. This paper is a very modest paper. It's a statistical exercise, which we think is very useful. I think it kind of imports 20 years of work in asset pricing to this question of fiscal sustainability. I don't think we want you to read more into this paper than a set of facts. And certainly the issue of is this ultimately sustainable or not? I agree with you. It's not something you can answer with these data alone. So that's one thing I wanted to say.
Steve,
I do think
we have
that,
many questions.
Yeah, let's take some questions. Why don't we go with Marco first? I think he was first, and then Manuel, and then Chetel. Marco.
A couple of quick things. So the correction that you used was for an AR1. I'm not worried that the correction is going to be dramatically different if you have a more sophisticated process, which I think you should have for deficits. But I'm worried that the standard errors are going to blow up on you and essentially tell you you have too small of a sample to answer the question, which is sort of what Refat in a way was also saying. The second thing is, I'm not sure what to make of Fed holdings. You argue that Fed holdings are a justification for this, but Fed holdings are kind of, for me, a swap of one type of government debt for another type of government debt, so that's not an answer.
Okay, so good questions. I think we can definitely look at a richer process in some other work. We estimated that maybe like an AR2 process actually fits the debt to GDP process better than an AR1 process, and it should definitely be feasible to redo that small sample bias under that alternative process. For the Fed holdings, I agree with that. I mean, that's kind of in this paper I just mentioned earlier, we think about QE and Fed holdings, and we model it as exactly a swap of long-term debt from the household sector and in return for short-term reserves that get issued to the intermediary sector. All I would point out is that if you believe that, for example, the rest of the world and the Fed have a different price elasticity of demand for that debt, that could potentially have an unwinding could potentially have equilibrium pricing implications. And potentially could affect, for example, the future returns on the debt. So that might be an adjustment mechanism. Manuel?
Okay, great paper and great discussion too. So I would just want to touch on something that Refat mentioned, which is the evidence for other countries, and also to another point that he raised. So there is a vibrant literature on quantitative sovereign debt models, right, that seeks to explain, default risk and spreads, and that literature somehow have moved away from, the debt sustainability exercises at IMF. We model government behavior. We think it's nonlinear. There is no nonlinear default cost implicit in these models. I mean, it's a very rich structure where. And then I think, if I were to apply your procedures or your techniques into this, there is something to be learned, something to be gained by merging these two things together. Anyway, just a thought.
Great. No, that's a great point, and gives me an opportunity to briefly talk about some of that questions that Rafat also brought up for Japan and Europe. I think interestingly, I think this excess smoothness finding is to some extent unique to the US. Certainly for developing countries, you do not find that, right? Because their surpluses do adjust. In fact, they need to run surpluses that actually go up in recessions, and because they know they cannot get away with pro-cyclical surpluses in the first place. So you do find large adjustments when in Argentina, a left-wing government gets elected, the 100-year bond fell 30% on that news, right? So that tells us that these mechanisms do work, and it's very different from the US. I think Japan is an interesting case. I think Michael Aterhano thinks it's all financial repression there. Another view there is that Japan is at the ZLB where fiscal spending can actually have a large multiplier. I think that's maybe something that's a little bit different there as well. But anyway, I do think that thinking a little bit about how to integrate this with the sovereign debt literature is definitely a good road to go. Chateau?
So there is I think a good reason to think that the process is not an AO1, but perhaps say an AO1 with time varying intercepts. So we know that there's strong political there's strong political impact on debt accumulation. So if you look at OECD countries, right-wing governments tend to issue more debt. Also in the US, you looked only at the US, but even there, and there's very strong regularity that the Democrats tend to, even if you include Obama, Democrats tend to repay more. So that could potentially change it. Now, unit root, I understand that you show that you cannot reject it, but somehow it has to be wrong. So just think of something, coming back to something that Rafat. I have to say, I really appreciate the paper. It's a very nice one and provocative, and also a very good discussion. Now, you think of the debt service capacity of a country. Say that the top of the Laffer curve is, I don't know, at 50% of GDP, say, and imagine that the growth is 1%, interest rate is 2%, and the growth is 1%. Well, then you could sustain debt to GDP of 50, right? So that's like 2 orders of magnitude larger than the median country. Now you would expect, if debt to GDP were a random walk, you would expect countries all over the place. The vast majority of countries is located between, say, 30% and 120%. And if you look at all countries, you go from -3 times GDP, Norway, to +3 times GDP, Japan. And there are no countries outside of that. If it were a unit root, why would everyone be centered around 50%?
Can I quickly add to this, that this is very much reminiscent of finding nominal interest rates to be unit roots, which we always do, but know that that really can't be for exactly the same reason.
Quick answer, and let's wrap it up, because
I'm not sure there's a quick answer to this question.
Okay, there's no quick answer. Maybe we should reply to that in the breakout room after Ricardo's presentation. So is that okay? Or you, unless you, yeah.
No, sounds good.
Okay.
Nice presentation.
We'll start again in 2 minutes. Okay, so that you can just drink a glass of water, and then we'll start again.
Same thing for unemployment, by the way.
Yeah.
Manuel, can I ask you a question?
Hey, Ricardo. Well.
So on your point, so my understanding of the literature you're referring to is that, though, the hard thing is that the punishments of default and others, the good thing about that literature that's rated quantitative is that you can go calibrate it, you can go and estimate it, do something. But wouldn't the challenge for Stein be that if you wanted to apply that kind of technology that we have, that because we've never observed the US defaulting, in the end, these results would all be driven by assumption of what happens. So is what you're suggesting that, look, ultimately we should use the estimates of default costs and properties of default from all
No, you're right in that.
they apply to the US? You see what I mean?
No,
Or
you're
am I
right.
wrong?
The US is the baseline in all of these models.
That's right, right. That's
It's the
another way to put it.
risk-free rate. So the spread is constructed vis-a-vis, say, the German bond if it's in Europe, or the US bond if you are Argentina or Mexico. So it is indeed an issue that if the US has default risk, then in principle the reference is gone.
Right. And then
and
you
the
know
whole
all the,
point
all
of
the
that
great
literature-
numbers and progs in that literature. I just don't know how to whether I can just translate
Yeah.
those numbers and parameters into
I don't
this.
know. I think it's a good point. I think it's not clear how you go about it.
Okay.
So I think I was not. It was not a critique. It was just more like.
Yeah, no. I was motivated by your question, thinking maybe I should write that paper. I was like, I don't think I can.
Yeah,
I don't know
thinking
to bring
how
those
would you?
numbers. I wouldn't know how to put them, right?
Right. So I think it's an interesting question. I mean, the whole point of the literature is alive, I think, because the spread is such an easy thing to
Right.
measure.
That's what I was saying. Yeah, you can measure these things as default. You can match the spreads with when default does happen, right?
That's right. That's right.
I wouldn't know how to. Maybe Stein will figure it out, I'm sure.
No, if there, I mean, also if there's like a deterioration in the fiscal condition, you can look at the default spread, right? You know, you can look at the yield spread. You can compare
Totally,
it to the default
totally.
spread.
No, that's exactly right. Yeah.
Excellent, that was great. So we have now Ricardo Rice from LSA presenting his paper on the constraint of public debt when R is smaller than G, but G is smaller than M. So thank you very much, Ricardo. The floor is yours. You have 35 minutes.
Okay, great. You can hear me and see the slides just to confirm. Yes, that's okay. Great. Okay, so thank you so much for having me here. I mean, I've been presenting this paper for a while in the last 12 months, and so some of you have seen it. I think this will be the last time I present it, but I think I've learned quite a bit, and it has evolved from many of your from many of the comments of people in this room as well as others. But ultimately, this paper is also this paper has really two parts and two contributions, or at least two things that I learned from it. And one is similar to Stein's paper, just looking through the budget constraint of the government and trying to kind of get some new insights by rearranging it in somewhat different ways, just like Stein just did. And then a second one is inspired by a rearrangement that I have found to be, to me, insightful, or it kind of got me thinking in different ways, then writing a model that makes sense of that term and what kind of implications you get. And in many ways, it is really a theory exercise of letting myself be surprised by some predictions that come out of it, and which I think are quite, again, surprised me and I learned something from. But being a paper about the government budget constraint, let me start by just defining terms in that government budget constraint in a accounting identity sense, but already giving you a hint of some things that will play a key role in the model later on. And so I'm going to write this in continuous time. That's not a particularly relevant point, but the total deficit or change in the debt is always equal to the primary deficit plus, or net spending S, plus the return to the bondholders. That's an identity. I'm going to right away restrict myself just a little bit, but that's actually not going to be necessary for the next few minutes, but it will show up in the model by saying that the spirit of the exercise here throughout the next 30 minutes is to think of spending as something that happens exogenously, and to think about whether that spending is consistent with a value to debt that's positive as opposed to zero. And it's going to be at times, because I want spending to scale with GDP, sometimes I'm going to have it scaling with output, sometimes I'm going to have it scaling with the debt, but think about it as S as being the exogenous thing and scaling with some quantity, which often is going to be debt. Second, note that this B, and this is an important point, actually, that Manuel rightly gave me a hard time when I gave a seminar about it, and it's really made me think more about, what is this B? This B is a value of the debt. It's not really a promised face value of the debt, meaning it's not, I owe you $100. This is what is the real value of the debt. And so if you think of B as being the face value, sorry, capital B as being the face value, V is then the price of the debt, how much a dollar of the debt is worth. And that's important, partly because then that means this is really aggregating across debts of different maturities and compositions and others. And therefore this V stands for their composite value. But also because, of course, it highlights that the return on the debt is a mix of some promised coupon, let me call it psi here, as well as capital gains and losses on the debt. So this little b is in some ways a jump variable, not a state variable, because even though big B is a state variable, little v can jump. Third, I am very often, or throughout this talk, very often going to resort to balanced growth paths. And while debt to GDP, this goes a little bit to the Uniroo discussion we're having, while debt to GDP could potentially explode I'm going to say that at some point debt GDP, the equilibrium that I'm going to focus on are ones in which it's ultimately debt is going to be growing at the same rate as GDP, which let's call it G for that. Well, I'll focus myself on that. So these are some of 3 restrictions in what is starting an identity. Now, I want to do a bit of perhaps complete trivial mathematics, which is to say, look, let dt be a sequence with a property that if you look at its average from 0 to dt, so this is kind of somewhat standard notation, then I'm going to have that the limit of this is bigger than the limit of the potentially growth rate of GDP. Well, if that is the case, then it is a matter of mathematics, by which I mean just rearrangement, that you can write this differential equation in its so-called integral form, where you essentially solve it forward, is what we'd often say in economics, and write that the debt is equal to the integral 0 to infinity of this ST discounted by D. Now you see why I call it D. It's a discount rate, as well as another term. And note that, by the way, you can do this equivalently by dividing by GDP. If you want to write as debt to GDP is the discount rate. And you see right away here why this property is important. The only way that these integrals would converge when you set the limit is precisely if these animals over here are strictly speaking positive. And that's why the condition D bigger than G is important for you to be able to write this as an equivalent way of the differential equation. Okay? This is a mathematical identity that holds for any sequence D, but that sequence better have this property. Okay, there's no economics in here, but there is, if you want, an important restriction here. I mean, I like to point to this trivial example. Let D be infinity, or an arbitrarily large number close enough to infinity. Well, then this term is 0, and this term is B0 divided by E0. So all you get is that B0 y 0 is equal to B0 y 0. So you need to convince yourself that mathematically these are equivalent. Now, the conventional analysis of government budget constraints, by which I mean hundreds of papers we've written about this. If you work for the IMF, this is kind of your life staring at this equation, which is saying, look, I'm going to set D to be equal to R. So I'm going to use as a discount rate the return on the government bonds. Remember, R is return on government bonds. And what that means is that the second term goes away when D is equal to R. And I'm only left with the first term, which in words that the debt GDP is the present value discounted by, oh, shouldn't have read D minus G, R minus G, but again, they're the same thing, of the primary balance divided by GDP. Okay. And an enormous debt sustainability literature has focused itself on forecasting surpluses, thinking about policy changes, commitments, CBOs, a lot of what it does, a lot of that sustainability. Some of the literature said, well, following Henning Bond's very influential work, let's estimate fiscal rules for S, especially S as a fraction of B. And now you see why the S scaling as B is something that makes sense in the terms of that literature. Or just like Schettel was just pointing to, well, let's think about Laffer curves as maximum values for these S, for these, and that gives us a notion of what's a maximum B0. You just saw literally Schettel do this 20 minutes ago, this kind of, well, there's a maximum here, there must be a maximum here of some kind. Likewise, in the theory literature, you have the famous austerity debates. If you lower your spending, that seems like this would increase the right-hand side. Yeah, but if it lowers growth rate, it may actually make you worse off. An element of the default literature, sure, you can lower the left-hand side, but if that shows up as the return on the debt as an expected default, you will also lower the right-hand side. You end up with a whole multiple equilibrium that at least in Guillermo Calvo we've been studying, and work on structural reforms of, well, if I spend more now to have an effect on future Gs or Rs, I may end up, again, structural reforms coming accompanied by potentially default risk along the way. And Andy Mueller and Schettel and Zilibotti have done some very recent interesting work on this, okay? But what happens though if R is not a valid D because R is less than G? That is what's coming in the title here, right? It is simply mathematically wrong to write this equation with an R. In other words, this equation, if R is less than G. You just cannot do this. And the mistake is simple that when you try to write an integral form, you're neglecting the fact that you have a limit of the sum is not the same as the sum of the limits when each term individually goes to infinity, diverge to infinity instead of converging, okay? So the title of this paper is, I want to still use this mathematically convenient equation, But I can no longer do conventional analysis if I think that R is less than G. However, while R is less than G, what this little math shows me is, hey, as long as I have a discount rate that's bigger than G, I can still at least do the mathematics. Question is, which one to use? There's, after all, so many. And the proposal, which again is the last part of the title, is what about using the returns to capital as opposed to the returns to debt? And I'm going to call those M. Okay, I just called them M because I thought of returns to capital as the marginal part of capital. I don't know. That's why I chose M, but it's the returns to capital if you want. In which case you get the equation just as before. This is still a present value, but now this term does not go to zero. Now, on this proposal, first of all, can I do this? Is M bigger than G? And so let me show you some very recent empirical work that isn't even in the draft, where I've gone and tried to measure, emulating very much the R star literature, start by showing that R has trended downwards, not just in the US, but across the G7, the advanced economies. The exception is the South Africa, Brazil, India, Russia, and China. But if you do the same for M, and what do I mean by M, returns to capital, taking a cue from Modigliani-Miller, I am not going to measure this as a return to some financial asset. There's been very large trends in financial structure, which means that the relative return to private equity, equity, or corporate bonds has changed. Well, Modigliani-Miller teach me that the way in which I want to measure the returns on capital in the economy is look at the fundamental, look at the pie. And so I'm going to measure this instead from national income product accounts. That is, I'm going to go to the national income product accounts and say, look, let me just measure the total operating surplus of the business sector. Firms, revenue minus their wage bill. That is a return to capital. Maybe it's a return to capitalists in the sense of those who rented the capital stock. Maybe it's a return to profits. Either way, it is a return to investing your capital in the capital stock, your savings in the capital stock, as opposed to in the government debt. So if I have a measure of the operating surplus, which I do, and I can build for pretty much every OECD country, because it's coming from the national income product accounts, and I divide this by the capital stock, I get a measure of what the average return on the capital stock is. And this is what I do here. And in my baseline estimates, I'm going to start from the operating surplus. I need to do some things about what do I do about self-employment. All of self-employment counts as a return to capital, but you probably want to subtract a fraction of that because that's really the return to the labor of the self-employed. And so I do that and follow the literature doing that. And for the capital here, I use private business capital in order to divide by that. And if you do that for the US, and this is a picture, if you do that for the US, what's striking is how flat that has been for 60 years, no downward trend. And then you do this for the G7, the advanced economies. And while different data definitions, some countries go a little up, some a little down, but overall, you end up with a conclusion of a remarkable, certainly over the last 20 years, remarkable constancy on the returns to capital. You may say, oh, but you're using business capital. What about public capital? Public capital, if the government is investing in roads as opposed to you building private roads, you should count that as a capital stock as well. You're overflating, Ricardo, the M by taking out what we spend in public capital. So then I said, well, what if I do it with total capital stock as opposed to business capital? You might say, well, what about capital gains? We know that there's an important trend. There's important changes in the relative price of investment in capital. And so what if we include the capital gains to the capital owner? On the other direction, by the way, you may say, well, you're assuming capital stock is reversible. If it was irreversible, you shouldn't have capital gains. And finally, do you want to take out taxes? Again, Modigliani-Miller logic says, not really, the government's just another stakeholder. But you may say, well, but for the private incentives, maybe you want to put in the taxes. Well, if you do those, you end up with an M that's either constant or actually increasing over time, slightly increasing over the last 20 years. You may say, well, I don't trust that operating surplus. Great, fine. Let's do this instead as 1 minus the labor share. Why? Because then I can piggyback on the whole literature of the last 15 years that has been about measuring the labor share properly. If you got the labor share, then I do 1 minus the labor share, divide by capital to income, and I have the return to capital. Again, from the profit accounts. It's essentially the same thing as saying, I don't trust the product accounts, I trust the income accounts. We know that income equals GDP, but as we know from measuring GDP, you can get discrepancies if you measure GDP from the income perspective or the product perspective. Well, if you do it this way again, M has been constant or increasing, solidly always above G. This is all to say that the decline in R that has made R less than G has not, I repeat, has not come with the decline in M. That is relevant because that says that using M is legitimate. Not only it is legitimate, it makes sense to use the M in the following sense. From a finance perspective, and I'm going to argue here for a broad class of models, a broad class of models in finance in valuing assets and payoffs falls within the general heading of the consumer asset pricing model. What is the insight of the consumer asset pricing model is, while you may have many different ways of discounting, the market, and that's the covariance of the market, the whole beta idea, is always a valid discount factor. Therefore, discounting by the market return is always a valid way of doing this. It's ultimately the insight of the CAPM. In macro in turns, if you think about the neoclassical growth model, what that tells you is always, well, at the margin, it is about the marginal product of capital, because the marginal holds the debt can invest in the capital stock. That is, in any neoclassical growth model, any model that has a neoclassical growth model as its heart, including the new Keynesian model, is going to say that the way in which the agent is going to discount things, the representative agent, would be using a returns to capital. Indeed, in the basic Ramsey model, the return on debt only exists as a shadow object due to Ricardo equivalence, and it's pegged to M in that model, but M is the fundamental concept. And finally, if you take a social planner perspective, and if you think about maximizing utility as social welfare function subject to resource constraints, it is M that is the way in which the planner is going to substitute across time, be able to substitute across time, and therefore that captures precisely what is the constraint that shows up, not R. So either from a finance macro social welfare perspective, M ends up being a relevant concept. Moreover, once you understand that this is then a present value of surpluses using an adequate discount factor that's both empirically legitimate and theoretically actually with a strong case for it, what this means though is that there's now a second term, which I've called, for lack of a better name, a revenue from issuing debt, or debt revenue for short. What is this? I think the simplest way to think about it is, for those of you trained as monetary economists at some point in your lives, is to remember your Sidrowski model or seigniorage terms. Remember, when the government only issues money stock, so the only public debt is money, and that money pays zero interest, then what's the private return of the economy? Was that private bonds give you instead a nominal interest rate. So what's M minus R? It's just a nominal interest rate. It's the opportunity cost of holding the cash. Well, nominal interest rate times the total amount of money is seigniorage. That's kind of what you learn at some point in graduate school when it's some version of Sidrowski or seigniorage. This term is nothing but an extension of that to the whole public debt. If it turns out that the debt gives a return that's below the private alternative, it means that the holders of the debt have an opportunity cost of holding debt. That opportunity cost has to have another side of the coin. Resources don't get lost. It must be that the government is having an opportunity, if you want, revenue of issuing debt. The government is collecting a seigniorage from issuing debt, and that is equal to M minus R times B. That's what this is. What drives M minus R? Luckily, we have a literature of 20 years full of models of why M is different from R. Models going back to the 80s of bubbles in the government debt, why R is low, but models of going to the 90s of the liquidity services that the bond gives, and that's why agents are willing to accept and pay the seigniorage to the government for holding government debt. Models of safety more recently in the last 10 years, why the government debt is safe and creates a value for it. Models even more sharply of just simply assuming there's a convenience, putting government bonds in utility function, many models in the last few years, and certainly models of repression where the government's forcing you to hold the debt, even though it gives you this dominated return, okay? Therefore, we have now this new term, this present value discounted by M minus G of the M minus R debt to GDP for it to for that. And what is this term? It is the revenue for the government from supplying the debt that for some reasons people are willing to hold, and I gave you a ton of them in the previous slide. Now, one thing that makes this term exciting beyond the fact that, hey, it seems to have a lot of empirical, theoretical support for it to exist, is that a realization that this may actually be quite high. It may be, or quite large, I'm sorry, to be proper English, quite large, not high. This comes with also a lot of work by Stein and co-authors that has been showing that this term is disappointingly small, consistent with that, And so that also feeds, I think, some of the excitement for why this term may be high, as well as come with different trade-offs. Why can it be high? Because of how large those M's and increasing M's have been. Namely, let me do a very simple calculation. Here is the R times B over Y, debt, flow payments on the debt. Remarkably constant over the last 20 years is average over the G7. Why? Because debt has increased, but R has fallen. R times B has actually been very constant in this direction of GDP. Instead, for the M, all of my pictures before were very consistent with an M minus R of 4% or an M of roughly 6%, since R has been on average over this period 2%. Very consistent with that, which, by the way, also follows from a Ramsey model. Kind of, you know, a fun thing is you go and pick up your Semoglu textbook, or I went back to my Barrow Sally Martin textbook over here that I had on my shelf, and their static calibrations chapter 2 were M 6%. It's kind of what follows from just looking at the Euler equation and backing out what you think is a marginal power of capital consistent with a G and the rho that we observe. Well, you plug that against the fact that the debt to GDP has increased so much, and even if I'm pessimistic and I say the M has stable, even though I show a ton of pictures increased, with a stable M and increasing debt, you end up with debt revenue terms that are as high as 9% of GDP, and namely 6%, or sorry, 9% GDP is just one term, sorry, 6% of GDP. Note that the deficits, if anything, went to -7, but you know, on average have been -2, -3. So you end up with the second term being, if anything, as big as the surplus term, a gigantic amount, a flow of 6% GDP, which in present value can be as much as 100% GDP. It's easy, it's not hard to argue, turns out, that almost all of the debt has been sustained by a term a little bit like this debt revenue term. And that feeds in, by the way, into the discussion in the previous paper. This goes to Stein's finding of, you know, the R minus S just can't explain very much. It seems to be this extra future debt, which in this kind of mathematical rearrangement, the future debt is nothing but a debt revenue term, another form of surplus, which the mathematics say, because after all, we're both looking at identities, it would just be thrown into this term once you rearrange the differential equation in this integral form that I do. So the term that Stein found accounts for 100%, again, just by mathematical rearrangement, is this term. And here I gave you a completely different argument from the one Stein gave you on why this can be very large and account for almost all of the debt that we have outstanding by going and measuring it in this particular way. Okay, so that's the first half of the paper. Noting that there's this way of rearranging that kind of tries to make some of the sense of, for instance, one view, one perspective on some of the results that we were just spent the last hour discussing. And this kind of way of going about measuring it seems to hold a lot of promise. Second part of the paper then is, okay, so you can measure it, it can be large. Does it lead to interesting trade-offs, such as we had the austerity debates, the structural reform debates that I told you? Remember, conventional analysis had two bits. One was measurement, one was trade-offs. I just kind of told you, hey, let's revisit measurement. Now I want to revisit trade-offs, policy trade-offs. To do so, like Rafet well put it, you need a model to have some trade-offs. So there you go beyond this M, R, and B and shifting, if you want, things from one term to another term. And so I'm going to write a model in which I'm going to end up with, again, I found one showed me why this term is also valuable, because I ended up with different trade-offs, different ways of thinking about the world. Okay, so that's going to be a model for this. Here's my model. I want to write a model where the reason why M is bigger than R is misallocation of capital, ultimately. That is, I want to write a model that is an AK model of in substance. AK also so that I can just jump the balanced growth paths and make the analysis as transparent and simple as possible. But hey, guys, my A is called M because of the first half of the paper. But otherwise, this would be A. A is M. It's the return to the capital, stock. But what turns out to be the case is that there's going to be a continuum of, if you want, well, better. There's going to be a continuum of types such that if you're high quality, you can capture the whole of that M. But if you're lower quality, you capture less and less of that M. And there's going to be some distribution. Important, this distribution has positive mass at the high quality, meaning I really want to make clear that there's a positive mass of guys who can just extract the whole returns to capital M. Okay. But then there's going to be a bunch of other guys who just have inferior capital. They therefore get less of a return on their capital, downweight by the Q. In the simplest case possible, a share of the alpha guys get the returns to capital, a share L just have terrible capital stock. they don't really get any returns to capital, and that's a share 1 minus alpha. Okay? Now, I'm going to add as well, but for this presentation, I'll only mention in passing, maybe there's also a risk component beyond the misallocation, which is that ex post, it also is that the Q equals 1 guys, their capital is riskless, delta is 0. But for any Q less than 1, you also end up with some depreciation shocks. That means that the guys who are not the high types both have low average returns and risky returns. So they really are inferior capitalists. I really want to make sure this is really a model of allocation, guys. This is not a model of risk. There's no aggregate risk. There's idiosyncratic risk, but this idiosyncratic risk is only in the form of making investing, if you're a low quality guy, just a bad idea. You should be doing that. You should be giving it to the high quality guy. Because then what happens at the households, what they would like to do is they can hold government bonds, they can lend to the other firms or the other households, or they can invest in their capital. Everything completely standard here. The key assumption is just this. And this is the key assumption in the paper, in what's otherwise an AK model. This is essentially a Kiyotaki-Moore assumption that says, look, if there's going to be a return to the individual type of capitalist, that guy can only promise to repay a fraction gamma against the private loans he receives of capital from the others. Okay? That's the Kiyotaki-Moore constraint. You can only get a leverage of gamma. Note importantly that R is going to show up in the constraint. The higher is interest rate, the more you're going to promise. You're going to have the higher interest rate, the less you're able to borrow if you're a firm because of this constraint. On the other hand, the higher is M, the more you're going to be able to borrow because there's a higher return coming in. Otherwise, market's clear. It's going to be a closed economy. The only outside asset is government bonds. And I'm going to write the government budget constraint. I'm going to look at it in steady state, look at an exogenous spending, as I told you, and look at whether the small can generate equilibrium with R less than G less than M, and an equilibrium where the value of debt is positive. If there are no credit frictions, gamma is 1, the model is extremely simple because it's an AK model. There's some productive massive guys, they invest, they get a fixed return, M, again, AK, and then everyone else should do exactly what we do in the AK model, which is lend to those guys. What's the return then on those loans, those private loans? M, from competition in access to among the AK the guys that have access to the superior technology. M is how much are we willing to lend to the government for? R as well, because I can lend to a firm or I can lend to the government. Therefore, M is equal to R, and then transalic initials will make sure that this is bigger than G. Done. If gamma is less than 1, though, or actually gamma less than 1 minus alpha is the condition, then you have, though, that the low quality guys can't lend everything to the high quality guys. And therefore, they're willing to lend to the government instead, because they'd like to save in case they become high quality guys in the future. Or I should have said, your types, you get a draw of type every instant. Therefore, the low quality guys are willing to lend to the government. They're going to lend to the high quality guys at a low interest rate because the interest rate at which they lend is the same as lend to the government. From their perspective, there's still a no arbitrage condition, but there's going to be a gap between M minus R. That gap is going to be higher the more there's this desire to save on the public debt, or the more there's a desire to put in the public debt to offset the risky idiosyncratic return. Because as low quality, you may end up investing in your capital stock. If you invest in your capital stock, you suffer risk, and then you get a second demand for the public debt from there. Okay? Now, the solution to the model is very simple in this simple case of 2 types only. Okay? So there's none of the depreciation risk. All there is these 2 types. And it's very, very simple. I can show it in really 2 conditions. A first condition is what's the growth in the economy? Simple. Alpha of the guys, the high quality guys, invest in their capital stock. They are an M. But on top of it, they're able to borrow from some low quality guys at the rate R, up to an amount gamma. So this is nothing but their leverage returns. And that is the growth of the economy, because that's the only capital being invested. Well, the growth of the economy then is going to have to be equated by from the Euler equation to the government budget constraint, which leads the growth of the economy to the amount of spending or surpluses that happen. But then from this equation, you get that for an exogenous S, and given that I'm having M exogenous, I can pin down R. Right away, what happens if you spend more? Well, the only way to spend more is if there's a bigger debt revenue term, i.e. a bigger gap between M and R. Well, but then R has to be lower for a fixed M. Bigger S must come with a low R. This is not a causal interpretation. I'm just working through the equilibrium. Big S must come with high debt revenue, must come with a low R. But you get then the countervailing effect, which is that there has to be a market clearing condition for the debt. And that market clearing condition says what? Well, 1 minus alpha of low quality can buy the debt. Alpha are going to buy the private capital. But the low quality guys, they can, of course, hold less debt by lending to the high quality guys. The higher is gamma, the less the debt to capital ratio. Well, what happens then if R are smaller? If R is smaller, I want to lend more. That relaxes the debt constraint of the high quality types. I want to lend more to them. I want to hold less public debt. And therefore, B falls for this, which has a countervailing effect on the debt revenue term. The nice thing about it is that you end up that more spending requires a higher premium, but lowers the ratio of public debt. And that leads then to a very natural definition of fiscal capacity, which I call big S. And that is the definition where if you try to spend more than this, the value, and I repeat again, the value of the debt would jump to zero. The only equilibrium becomes where the value of the debt is zero. Why? Because you simply cannot have an M minus R that's big enough with a positive B that is able to sustain that large amount of deficits. The expression for that turns out to have a nice intuitive flavor. Or in particular, let me emphasize the two important bits of it. Remember, financial development's economy is really proxied by two parameters, gamma and alpha. Alpha is how much of the initial capital is in the hands of the high productive guys. Higher alpha means we all have access to the AK, the good technology. Low alpha means only a few of us have access to it. Second, gamma is how much to what extent can the guys who don't have access still lend to the guys who have high access? So gamma and alpha are just two measures of financial development, either initial allocation or the one, how much can the debt markets, the private capital markets then reallocate after an inefficient allocation? Well, if there's more financial development in this economy, high alpha or high gamma, high alpha or high gamma, then what you have is that the fiscal capacity is lower. And that's kind of a surprising result because what it says is more financially developed economies actually have less fiscal capacity. Now, this is a ceteris paribus. This is not an empirical prediction. But why is it a useful result? Because it shows you basically what's at the heart of this model. The heart of this model shows that the debt revenue term is about the specialness of public debt. And the public debt is special here because it competes with the private debt. If you make the private debt market work better, that takes resources away from the public debt market and therefore lowers that revenue terms and therefore lowers fiscal capacity. That is the key insight of the model, that once you start thinking in terms of debt revenue terms, start thinking of what generates the specialness of the debt. Well, a more financially developed economy means the public debt is less special. It's providing less liquidity, less safety, less ability to transfer resources, okay? You can extend this now to the more general case.
Ricardo, you have 2 more minutes.
Okay, and you end up with, yeah, absolutely. We end up with a similar result. You can extend this to have now, what if instead of having the jump in the value of debt, what if I had with a different fiscal rule? Well, then I end up with, instead of jumps, transition dynamics. There's now both a stable equilibrium, which I described in proposition, as well as an unstable equilibrium, but there's still a clear definition of a CAP-S and now convergence. You can let go of the AK to instead have a production function. What happens now is that the growth of the economy is exogenous, but the returns to capital are endogenous, as opposed to the M being fixed. Now the M moves around. You end up with a similar result, at least in terms of there is an S, and financial development lowers that S. You may end up, can do an extension to an open economy, and likewise you end up with that. Second, though, is the model beyond having this prediction then has the following 3 predictions on the size of this fiscal capacity. First, if you have coerced debt, you can force agents to hold debt, you increase the debt revenue term because you just create a repression premium. Nothing surprising here. But now think about what if you extend it to have nominal values and inflation? Well, then an attempt to inflate away the debt, an increase in the standard deviation of inflation, because it makes the public debt less safe, more risky, leads to a lower debt revenue term and expectation, and in doing so, therefore, lowers the sustainability of the debt. There is no conflict in this model between price stability and fiscal sustainability, because it's price stability that maximizes the debt revenue term. When you think about debt revenue term, instead of surpluses, you realize, wait, I need to make this debt revenue stream big. How do I do that? With price stability, by making the debt safer. Likewise, if you do redistribution, well, again, the key is, does redistribution from the high types to the low types, does that potentially lower capacity? And the answer in this model is yes, it does. Because when you do redistribution, you're activating private capital markets. Activating private capital markets lowers the demand for public debt. And so you end up with a result where you, even though redistribution may be a wonderful thing to do, in this model, it's clearly Pareto efficient or welfare improving, sorry, to do some redistribution because there's this risk that's facing agent. Social insurance lowers the debt revenue term. And the reason why I put this proposition is to understand fiscal sustainability or capacity is not the same as welfare. Finally, an increase in the tax rate here increases surpluses, the first term in the government budget constraint, but lowers fiscal capacity. Why does it lower fiscal capacity? Because an increase in tax rate tightens the borrowing constraint. By tightening the borrowing constraint, hurts the ability of the private debt markets to work. And so again, you have that by thinking about the debt revenue term, you end up with a very different trade-off where higher taxes may actually, or other direction, tax cuts may pay for themselves, because even if they lower the present value of revenue term, they increase the debt revenue term. Conclude. I try to understand what is the constraint of public debt when R is less than G, but as is true in the data, M is high and constant. And I try to make, well, I guess 4 points. I said 3 points, but 4 points. R has fallen, but M has not. And you have to be careful with using models that keep R is equal to M. There is a debt revenue term. It can be very large. There is one model debt revenue term that I proposed, which is entirely about competition between public debt and private credit markets. And once you do that, you see that monetary policy, or better, inflation, even if it lowers the value of the debt, increases debt revenue terms. So inflating the debt is a bad idea. Raising taxes may be a bad idea, even if they increase present value surplus because they lower that revenue term. Redistribution can raise welfare and lower the debt revenue term. In other words, that thinking in terms of debt revenue term leads to, as I told you at the start, has led me to understand in different ways, different trade-offs that emerge here. And I'll stop there. Thank you.
Thank you very much. Pier Paolo Benigna from the University of Bern is a discussant. Pier Paolo, can you share your slides?
Yes.
Excellent.
Okay.
Yeah, 10 minutes.
Hear me? So thank you very much for inviting me to discuss this paper. So this is a clearly well-written paper on an important topic. Riccardo mentioned that has been presented several times, discussed several times, and that's the last. This is the last discussion. Hard to find, comments to be the last discussion. I don't know what other people have said in this paper. So it talks about sustainability. It's arithmetics, but more deeply to me is about how we think government obligations in practice and in theory. And I'm going to focus on, in my discussion, on 2 lines: the policy relevance and the theoretical relevance. So let me go to the policy relevance. And here, one point which I was in some way was very emphasized in the introduction of the paper, but not in the presentation of Riccardo, is that according to this theory, in some way, government can run perpetual deficit. Okay, so this is a point I'm going to, in some way, discuss more. And it was striking to me that what does it mean? So I'm thinking about a new country. There is a new country, actually, that recently has issued that for the first time. So let's see how they did. And this country is the old continent, actually. So following the pandemic shock, the European Union has implemented a plan, a fiscal plan of approximately 800 billion. And this is taken from the Commission website, and I think they're a very interesting word. So the EU is going to borrow on the capital markets, and thanks to the EU high credit rating, this is very important, the Commission is able to borrow on advantageous conditions. So that's a lot to do with this paper here. And what is striking and what is a bit interesting with respect to this paper is that the borrowing will be concentrated between mid-2021 to 2026, but all the borrowing will be repaid by 2058. That's what they say. So in some way, very simply, today they start and they give a transfer to countries minus T at time T0, and T is debt. And what they do, what they plan to do is to pay the debt. So there is an interest rate on that, and then they're going to raise taxes eventually at some point in time. They say 2058 to pay the debt. So this is how this policymaker have thought about issuing for the first time debt for the European Union. And the key aspect is that they're going to repay. So here is again the equation, just to state it. And I want to understand what is R. So I've been cheating a little bit because my R is I in my model, okay, so that's it. So here is R. What is G? And I don't see any G, but I can understand that there is an importance of G. You know, you can see that they have to raise taxes. If we think that these taxes come from income taxes, then they're going to depend on GDP in the future in 2058. So if the economy is going to grow a lot, you know, you're going to need less tax rate in some way to pay this debt. And that's the idea actually behind the plan, right? You want to give money to countries today, you want them to invest in a way that grows, is going to pay the debt, right? But at the end of the day, whatever is G, they're planning to pay. So it doesn't matter, right? You know, there's going to be less taxes with respect to GDP, but they're going to raise taxes in nominal terms to pay this amount of debt. Actually, on a very policy grounds, you know, why is relevant G? Could be the wealth of people because they can tax wealth and they can raise taxes from wealth, right? So that could be another indicator. So where is M here? M comes because this I could be low, right? Perhaps, and that's exactly what the Commission say, wow, we can borrow at very good condition. And those conditions are sort of why you can get a lower interest rate. And so there is an advantage there because they can get lower interest rate on this borrowing, but at the end of the day, they can pay, they will pay less taxes, but they have to pay taxes. So that's the plan. So whether there is a G, M, different, yeah, it matters, but not much. So the question is, where is the perpetual deficit here? And the second question, what is sustainability? And this is going back to Refet's points in previous paper. It's a coincidence we were in the same class, so perhaps we raised the same points. So what is sustainability in this framework? Again, the same equation here. Well, what is a perpetual deficit? There is no perpetual deficit in this experiment. They're going to pay taxes. But it could happen, I think, that in 2058, the European Union may decide to finance the outstanding debt by borrowing again on the market. Okay, they can say, okay, that's the way to pay, right? We can borrow, raise money, and other 30 years of borrowing. And this is going to be time T tilde. The question is, on which premises and promises can they get favorable market rates again? Here we have time T0, they roll over the debt, and at some point in time, I guess they are expecting to have some taxes there, right? So otherwise, why the market would give them a good rates if they're not paying the debt? So the concept of sustainability is this. Eventually, this deficit today should be paid by surplus at some point in time. there is no perpetual deficit, at least in the idea of these policymakers. And in particular is important because you need to have a fiscal capacity to pay the debt or to get good favorable conditions, even if the time is very far in the future. So yeah, we can roll over, but this fiscal capacity should be there. So at some point in time, you should be able to pay. And perhaps the magic is that the government can do this for a long period of time that we can. And that was the sample also of Rafet about this firm, but here the government may have a longer time, but at some point in time, there should be some fiscal capacity to get this interest rate, which has a premium, which is important in a Ricardo analysis. So the theoretical relevance of the work. There is one agent here in the economy, Ricardo knows a lot because he has written on these things, that can borrow at will. And it's chosen rate indefinitely in the future. So there is one agent that can set here B and interest rates. It doesn't have any market requirement of demand and supply. So this is the central bank. The central bank can run a perpetual deficit. That's the theory. Now, in my view, this paper should be a paper about central bank borrowing. So last point in the conclusion of Ricardo, interaction between monetary and fiscal policy. Well, I think this is key to talk about this premium, perpetual deficit. How do we think about deficit? How do we think about sustainability of the treasury? And so this should be about nominal liabilities. It's not a paper about real liabilities. And it becomes a paper about inflation and price determination. And that's, I guess, Ricardo mentioned fairly. This seems paper and he says a complementary paper. And I guess that's, to me, there is some, I was wondering why Chris has written a paper in this way on inflation and prices. And to me, is the paper to write here. So central bank can run perpetual deficit, but there is a limit to this. And this is the limit. There is an equilibrium condition in models. Now, it's not the same as in Ricardo model, but you can think this comes in any other type of models, and it has to do a lot with this R, M, and R. So here we have the overall government obligation. One feature which may be important is that I'm considering just short-term debt. So long-term debt, for the argument of Ricardo, can have some jumping effect. Here we have Q, and Q depends on two things. It depends on reserves of the central bank with an interest rate IX, and on the debt, and on the treasury debt in the hands of the private sector with an interest rate IB. Okay, so this is the liabilities, nominal liabilities, and this is the price level. And in equilibrium, this should be equal to the present discounted value. Discount factor is usually this M of the taxes, real taxes, plus two terms of seigniorage, depending on the one on treasury debt and the one on reserves. And because the interest rate can be different here. And primarily, the central bank set this IX. IB is determined by the market, by the capacity of fiscal policy. IT is another market rate, which depends on other elements of a model.
Here, Paolo, you have to wrap it up soon.
Yes.
You're out of time.
So this is an equilibrium condition, it's not a solvency constraint. So there's a difference. It's not about sustainability here. It's just say that government real obligation should match real revenue. So how we think here? B is subject to a solvency condition, as discussed before, and therefore taxes should adjust in an appropriate way. So the liquidity premium depends on fiscal backing ability of the treasury. X, the reserves are not subject to solvency condition, but the premium depends on abundance or scarcity of reserves. So there is a bound on these seigniorage revenues. And the treasury cannot run a perpetual deficit unless it is backed by the central bank. Some way Marco was saying, oh, this is a swap between within the government. Yes, if we think about that, this is a joint operation between treasury and central bank. So in this case, the treasury can run a perpetual deficit. Yes, it can vary this as it wants because it's backed by the central bank. But what is squaring this equation is movement in the price level at the end of the day. So that's how I would think about sustainability here of this equation. Okay, so let me wrap up. So I think 3 points. Treasury debt has to be paid, in my view. If the central bank implicitly backs the treasury, then it could carry a risk-free rate and a convenience yield and can be not prepaid. But in this case, there is no solvency requirement. There is an equilibrium condition, and the adjustment comes through prices and inflation. Thank you very much.
Thank you, Pier Paolo. Ricardo, would you like to comment on Pier Paolo, and then can take some questions from the audience?
Absolutely. Thank you, Pier Paolo, for your comments. Were very useful. In terms of just 2 brief remarks, if you want, which mostly to help others understand some of the terms, or at least the way I understand some of the points. The first one is that you are right. I mean, I'm thinking of that sustainability in the sense of there is a value of the debt that's backed by future taxes. I was clear in that I was looking at that value of debt as a function of that for an amount of face value of debt, how the value of that changes with the price of that, what I call the little v's. Now, one perspective is say, no, the amount of the debt issued was a form of money that has a fixed in nominal terms. So the adjustment in the value of the debt have to come through a price level. And then the equation that I showed is, as you just put it, about the government, the central bank's liabilities, and becomes a theory of the price level. But importantly, note that for that theory of price level, as you showed, you have a term there that's very important, the I minus IV in your notation, which is my debt revenue term. And so my point is, for me to understand inflation as you wanted me to understand it, it's very important that we think about this term, how to measure it, how to trade it off, and then everything I said hopefully is useful for you. And I'd point to a paper by Marco Bassetto and Wei Q a few years ago that tried to do that, as well as more recent work by Bruno Meyer, Merkel, and Sannikov, who try to do precisely this. That is not excluded by the analysis that I did. I was a little broader and thought, look, but the value of debt may also be the fact that you are trying to sell some amount of debt and you're going to get some resources against it. The amount, the resource that you get are then again a function of the present value of surpluses plus the present value of that revenue terms. And so putting it backwards in terms of your discussion, Pier Paolo, if the European Commission promised to give me a fixed amount of taxes 35 years from now, how much would it be willing to borrow against it? That is the perspective I'm looking at and saying, is that large, is that small, and framing it in terms of a debt sustainability analysis. But you can go in that perspective. And the insight is that from that perspective, well, that revenue term extends beyond the central bank liabilities, but includes also the public debt, insofar as maybe you're able to, for a fixed T, able to borrow more of a VB in my notation relative to what you had. And that then is also the point on, as you said, you look for it, all that shows up is the I, if you just look at face value of the debt versus face value of taxes. But when you ask how many resources, that is, by how much will that debt have to sell, how many resources will explain, which, Pier Paolo, you say, well, to me, that's the price level because you're thinking from a central bank liability, but more generally from the government, that's just government bonds, because then your B has to be multiplied by whatever price the government is able to sell those bonds. That's where then it shows up this sustainability, which, putting it backwards relative to what you did, is saying, you said, I borrowed 500 million, how much do I have to tax? I say, given that I'm going to give you a tax or something 50 years from now, how much would we be able to borrow today? And that's sustainability. And the point being, there's a large component of that, which is what I call these debt revenues. So I hope that was useful. Maybe I just confused people more, but nothing inconsistent. And Pier Paolo's It's completely right in everything you said. Just, yeah.
Let's have time for one question, and then we'll continue in the breakout rooms where you can continue the discussion of everything. So anybody wants to ask a question now from the audience? Okay, Manuel, go ahead, and then we'll go to the breakout rooms. Unmute yourself. Yes.
This will be much better in person. You don't have to press buttons.
Okay, so let's do the following. Let's so in your, yeah, actually we're exactly on time. So there is go to the breakout rooms and you can join. There's one for Steen, one for Ricardo, where there was going to be discussion for the next 15 minutes, as yesterday, about the papers. So please join the respective room, and so that people find you when they go there. And we'll resume in 15 minutes with my presentation. Okay, see you in 15 minutes. Steen, you have to go and join. I don't know if you see it.
Is there like a link?
Yeah, go to the breakout rooms in the.
Is this in the chat or?
Yeah, next to the chat, next to the reactions, the whiteboard, there is a little thing called breakout rooms. Go there. And then you see down the name of the various participants, and you see your name, and you just press join in that particular one. Okay, got it. You got it. You get Paolo.
Are you ready?
I have to be.
Okay. How are you?
You know, I'm okay. You know, I'm actually, when you keep the time, you don't really pay attention to the papers. You keep more of the time, attention to the clock and less on the papers. So in any case, everything's good. We'll catch up later. I guess I should share my slides soon.
All right, I think we're ready to start. the second last paper, Tassos, go ahead.
Thank you. Thanks to all for being here. We're happy to see you. Let me show. Okay, excellent. So, thanks for being here. I'm very glad that all of you are participating, for the speakers, the discussants, and to the audience. So let's see what am I talking about in this paper. In this paper, I'm asking a very simple question, really. I'm asking a basic question of macroeconomic policy. And the question is the following. Should we tax today or should we postpone taxes and issue debt? Always remember that debt means future taxes. In order to talk seriously about a question like that, we need to understand the trade-offs. And in order to understand the trade-offs, we have to understand the price of government debt, meaning returns. All the papers we have seen today and yesterday have more or less are talking about returns. So in this paper, I'm going to build a general theory of optimal fiscal policy around the following tax smoothing principle. We'll show the math later, but here I want to show you schematically what all the mechanism will be about. So think of the following. Think about choosing debt. Always when you want to think about taxing today versus taxing tomorrow, you have to think about how much debt you issue for tomorrow. So by issuing debt, some measure of debt for tomorrow, there's always a marginal cost, which is the left-hand side of this equation. And the marginal cost is that you have to pay more taxes for the future, in the future. On the other hand, the right-hand side of this equation shows the marginal benefit of debt. And the marginal benefit is just whatever revenue you get from issuing more debt times the social value, the shadow value of relaxing your government budget. We can write this marginal revenue as obviously, price times the derivative of prices with respect to this measure of debt. And the entire paper I'm going to, today is going to be about effectively this derivative, about this marginal revenue component. But what I want to tell you here is that keep in mind that whatever I'm going to find, this equation tells me that put always more taxes on states or dates of the world for which marginal revenue of debt is high. If you want to think about today versus tomorrow, tax more tomorrow versus today if it's cheaper to issue debt. Something very natural. That's what this equation is saying. And we will see, even in the more complicated environments, we'll see, we'll consider that this equation will show up. So, in order to talk about that seriously, I have to talk about the market value of the government debt portfolio. In order to talk about this marginal revenue component. And this consists of three things. One, the stochastic will depend on the stochastic discount factor. For example, if I have time-out utility versus recursive utility. Two, it will depend on my market structure. If I have complete markets like a full set of state contingent securities or incomplete markets, either non-contingent or something between. And obviously the timing protocol. Do you have commitment? Do you have discretion? Do you have something between? All of these things will determine the market value of government debt and therefore the incentives for taxing today versus tomorrow. So what I'm going to do exactly in this paper is I'm going to take asset prices seriously. And by that, how am I going to take them seriously? I'm going to use a plausible model of asset returns. I'm going to use a generalized version of recursive utility. So on these elements, I will use the recursive utility, fine, a generalized version. And then I will be very expansive because I'm going to consider four environments. I'm going to consider complete or incomplete markets. And I'm going to consider also commitment versus discretion. By discretion, I mean mark of perfect equilibria. Of course, I will have no time to go over the discretionary stuff, so look at the paper if you're interested. So in the presentation, I will focus on the commitment case and talk about complete markets and incomplete markets with recursive utility. The interesting thing is that with recursive utility, this marginal revenue component I talked about in the first slide gets really activated, gets really important. Whereas with time-out utility, it's not even there. And the same kind of principle for taxation will show up in all these environments I'm going to consider, but this will not imply tax smoothing. Because it's not just the tax smoothing that matters, it's tax smoothing times the marginal revenue part. So let me give you a preview of the results, and then I'll go to the environment. So with complete markets, let me remind you of, just to be clear here, I'm going to consider economies without any kind of frictions, a representative agent, effectively what you learn in your first year in graduate school. So, so what do we know about this kind of environments? With time-added utility, the environment I'm going to have in mind is Lucas and Stocky. So in this economy, what do we know? There is one basic result, is you keep the labor tax essentially constant. That's the standard tax modeling result we know. Second, there are no any drift. So wherever you start, that's where you stay. There are not either any positive drifts or negative drifts in taxes or debt. And third, there's no endogenous persistence coming from exogenous variables. When you go to recursive utility, we will see that taxes are not constant, and you will have a tendency to tax more in good times and less in bad times. Second, there will be backloading of distortions, so there will be positive drifts in taxes and debt. And third, there will be very high endogenous persistence. Keep that in mind. Let's go now to incomplete markets. What we know for the time-added case is the work by Barrow and Ayagarma, Sarge, and Sepala. What do you do there? You make taxes, instead of making them constant, more or less, you make them random walks. And you tax more in bad times and less in good times. So you average distortions, and you tax more in bad times versus good times. So with recursive utility, what I'm going to find is that you tax even more in bad times and even less in good times. And this random walk results of Barrow will break down. There will not be any averaging of taxes. So, because the paper has many results, but I'm going to, I don't know how much time I'll have to go over all of them here, but let's go to the environment. So the economy will be very simple. It will be an economy without capital. We'll have exogenous government expenditures and stochastic. This will be the only source of uncertainty. You can easily put also TFP shocks. The risk constraint is consumption plus government, private consumption plus government consumption is equal to output, which is just equal to labor. And G superscript is just the history of shocks till time t. So I will consider two market structures. One will be the complete market structure, where I want to have state contingent debt. So I will just write down the budget constraint of the government is debt in the beginning of the period is equal to the primary surplus plus the portfolio of new debt. And this PT is just the price of our securities, okay? And I will also consider the other extreme within complete markets, where I have non-contingent debt, as in Ayagarma, Sarge, and Sepala. And there, I will have debt in the beginning of the period will be function only of information till t-1, it's not contingent. And that's why I'm also changing the time script, the subscript here. So it's t-1. So whatever has subscript t is always function information time t. So is equal to what? The surplus plus the price of new debt Q plus new debt. This is effectively my economy. And the only thing I have not talked about is preferences. We have here labor taxes, as you see, linear distortion taxation. We could have also consumption taxes if you want. It would be equivalent. So let's go back now. Let's go to the preferences. As I said, I'm going to have a general form of recursive utility. What I'm going to have is utility today is some period utility of consumption and leisure, 1 minus h is leisure, plus beta times a certain equivalent of future utility. And the only thing I'm going to assume is that this certain equivalent is increasing and concave. So my only assumption here will be there will be aversion towards risks, towards future risks, towards risks in, let me be precise, people will dislike volatility in future utility. That's what I'm going to assume. One more thing for notation later is I will call A of X the coefficient of absolute risk aversion. Why do I care about that? It will show up in my formula, so keep that in mind. And this environment here nests everything you may know. So for the time-added case, it's just you are neutral with respect to risks, with respect to volatility and future utility. you are risk neutral with respect to this kind of volatility, whereas you're not risk neutral with respect to volatility in consumption, right? That's the time additive case. Now I will do the entire analysis for any kind of H. Whenever I want to consider parametric examples, I'm going to consider 3 nice parametric examples, and they will be the obvious ones. What you expect? I will either assume constant absolute risk aversion, so this H will be an exponential function. Constant relative risk aversion, this H will be a power function. When I have the exponential, by the way, I don't have any kind of restrictions in the period utility. When I go to the power case, I will add restrictions so that my U, my period utility, is positive, right? And I can also have the logarithm case. H of X is the logarithm of X. Okay, so this kind of references, this will be the ones I'm going to use, and that's the following. Then as epsilon z, if you assume some power certain equivalent and some particular period utility function, you assume the sensitive preferences of Talarin and Hansen and Sargent. They nest work by Swanson, and more or less all the whatever has happened in the literature. Okay, so I want to talk about optimal policy. So let's go to that. I'm going step by step, otherwise you will not figure out my expressions. So we won't talk about prices. And for prices, we'll need to talk about the stochastic discount factor. So my stochastic discount factor will depend on 2 components here. One will be the ratio of period marginal utilities, which typically for the standard period utilities we use is as consumption growth sum power, and an additional term that depends on continuation utilities. This additional term, I will call it MT plus 1, and it will be just the derivative of the H function evaluated at future utility, scaled by the derivative of the H function evaluated at mu t. Mu t is the certainty equivalent of future utility. So what do we see here? Immediately when we have the time additive case, H is a linear function, this thing becomes, MT plus 1 becomes automatically unity. Obviously, also when we are in the deterministic case, the certainty equivalent of future utility is equal to future utility, so also this term disappears as well. And the way I'm going to think about this term is like in the asset pricing literature, it captures effectively long future utilities. So many times in the asset pricing literature, this is called like capturing the long run versus consumption growth next period captures the short run. Okay. What's important to have in my mind is that whenever I have decreases in utility, I have increases in the SDF. That will be important in order to think about my taxation results. Let's see also this formula, how it shows up in my 3 parametric examples. In the exponential case, it just shows up as an exponential twist of essentially the probabilities that the agent assigns. This can also have an ambiguity of an interpretation. I'm not focusing on that now, but it could. The power case is, but the important thing is this MT plus 1 is just a change of measure in the exponential case. It integrates to 1 and it's positive, right? The power case is, it shows up as some other kind of change of measure, kappa, in some power. What do I care about this kappa? It will show up in my results. And for the logarithmic case, it doesn't have any interpretation as change of measure. Okay. Now, we think about optimal policy. What's the problem here? We have distortional taxation. It will show up as in the labor as a distortion in the in the labor supply condition, and we'll set up an optimal policy problem. As I told you, I will consider the commitment case. So I will have a planner that will choose to tax rates to maximize utility in order to the utility of the representative household, and he's going to do that at time 0 and stick to this plan. So there are various ways how you formulate this problem. I will not go over the technicalities here, but I will form this commitment problem recursively. What will be important is that my value functions, exactly because they show up in stochastic discount factors, they affect prices, and therefore they will affect the constraints that the planner is facing. So value functions will show up in implementability constraints. This will make the problem non-standard. And this is also what adds difficulty computation to the problem and theoretically, but in any case. And what I will use as my state variable in order to represent the commitment problem recursively will be for the complete market's debt times margin utility. That's my variable Z. And for the incomplete markets, it will be average debt times, debt times average margin utility. That will be my capital case B. So this will be my measures of debt in the cases for the complete markets and incomplete markets. And they combine something about debt and margin utility. Think of that because it's the commitment solution. I need in my state variable something that captures past promises. That's why margin utility enters there. And let's understand now about what will happen. I will not open the buttons because, given the time constraints. Another one important thing is that what will be the most important variable in this setup will be my multiplier on my implementability constraint, which I will call excess burden of taxation. I will call it phi t. I will index by t. And this, I will think of that as capturing taxes. This is, in some cases, actually one-to-one, the relationship of this with the taxes. But this is, whenever I talk about taxes, effectively, I will be talking about this multiplier. So let's understand, before I show you the equation, let's understand a little bit about the economics. So think about, imagine I had this kind of setup, I showed the infinite horizon setup, but imagine I just have 2 periods. And I'm at period 0, and at time 1, as I'm at period 0, I'm the planner, and at time 1, I can have 2 realizations of the shock. The shock can be low, good times, or the shock can be high, bad times. As a planner now, what am I going to do is I'm issuing state contingent debt. We have complete markets. How am I going to do that? I'm going to sell debt against bad times. Sorry, I'm going to sell debt against good times that I'm going to pay back by running a surplus when the good times of low government expenditures happen. And I'm going to buy assets or sell less debt against bad times that would allow me to finance a deficit when bad times happen. This is how insuring gives good and bad times. So this is how you do fiscal hedging. So this coming from the market structure. The question is, since we're talking about ultimate taxation and ultimate debt issuance, is how much debt and how much assets. With expect utility, what you try to do is you issue so much debt, state contingent debt, and so much state contingent assets so that you make the tax rate constant across good and bad times. With recursive utility, though, what will be important is that now, let's open it. Yeah, the result will be is the planner will sell actually even more state contingent debt against good times, which implies that the planner runs higher surpluses in good times, and will also buy more state contingent assets in bad times that will actually allow the planner to run a larger deficit in bad times. So effectively, the planner will over-insure and run larger deficits in bad times and larger surpluses in good times. Why is that? That's where we're going to the recursive utility stuff, the stochastic discount factor. By issuing more debt against good times, I reduce the utility of the agent in good times. This would be the same either in the recursive utility or the time-added utility. But in the recursive utility, this has a direct pricing effect because by reducing utility in bad times, you increase the stochastic discount factor. So effectively, the planner can increase the price of the ARO security that pays in good times. By increasing the price of claims that the planner is selling, he increases the revenue, and therefore he relaxes the government budget. So what happens is by issuing more debt against good times, and similarly buy more assets against bad times, the planner can effectively achieve more revenue and reduce taxes today. So this kind of intuition, I mean, this is the mechanism, not the intuition, is what will determine the results. So I gave you in just schematically in a two-period model the result. Let me show you now the equations. So let's go back to my optimality condition with respect to debt. Going effectively to my first slide. By issuing more debt, what do I get? On the left-hand side, let's go to the time added utility. On the left-hand side, I have to have some marginal cost, which means more tax tomorrow, which translates to the excess burden of taxation tomorrow. That's my phi t plus 1. But on the right-hand side, I have what? I get some marginal revenue that has some shadow value phi t. The point is with time added utility, the marginal revenue is trivial. It's just unity here. So what happens with this initial equation that I had was that this equation just tells you, oh, I equalize the excess burden of tomorrow for any kind of state tomorrow with the excess burden today. So I just make the cost of distortions constant over states and dates. And that's the source of tax smoothing in the standard model. Now, going to recast utility, there will be this marginal revenue component that after you do various tricks, you can write that in this nice way, which will be, instead of having phi t plus 1 is equal phi t, equalize excess burden, you'll have the inverse of the excess burden tomorrow is equal to the inverse of the excess burden today minus a term. What is this term? Eta. I will call it eta. This term immediately will be, you will see it, you will be 0 if I'm back to the time added case. And what it is the following. This term captures what? Debt in marginal utility units adjusted by the coefficient of absolute risk aversion. And this is constructed to the entire value of the portfolio of the government, which in my notation now is ET plus 1, CT plus 1, adjusted by, again, the coefficient of absolute risk aversion evaluated at the certain equivalent. So think of that as a measure of relative debt properly adjusted with absolute risk aversion. Immediately, you know that going to the time added case, necessarily, since the coefficient of absolute risk aversion has to be 0 in that case, this eta t plus 1 is just 0. Furthermore, you know, if we're in the deterministic case, this automatically becomes also 0, right? So effectively, time added utility case with uncertainty or just a deterministic case, there's no difference as far as optimal taxation is concerned. Now, but let's try to understand what it means. I will read now from this equation what I was giving you 2 slides ago. So let's try that again. And one more thing. This equation here about the inverse excess burden of taxation holds for any kind of certain equivalent I have. So it's a very general result. Now, what does it say? Well, it says that if this eta t plus 1 for some particular shock is high, it's positive, then I will tax tomorrow more than today. And if this eta t plus 1 is negative, I will tax less than today. The point is that I expect this debt, typically this debt in marginal utility units tends to be, I tend to issue more debt in marginal utility units in good times and less in bad times, which means, this is because of the fiscal hedging I was talking before, I tend to issue more debt against good times and less debt against bad times, which just translates in this equation that I just put more tax distortions in good times and less tax distortions in bad times. And this is exactly because that's my way I can manipulate the return of state contingent securities. I sell securities in good times, I buy securities in bad times, so this is the way I can increase my revenue from this portfolio. And this is what exactly this equation shows. So effectively, this is the amplification of Lucas and Stokey, and obviously Lucas and Stokey is nested here, right? By the way, the same things happen also if we had capital. So this, you know, the same equation would show up. Now, I said this thing. Let's go, I'll have 10 more minutes. So let me open 2 I want to open, first of all, my parametric examples, because there's one more thing about this equation. Let's open my 3 parametric examples. Let's start with the exponential. When I have the exponential, this equation becomes much simpler. The coefficient of absolute risk aversion is constant, so it goes out. So this eta t plus 1 is just an innovation in terms of debt and marginal utility units, and has mean 0, which means 1 over phi t is a martingale with respect to this kind of measure that I have here. Okay, martingale immediately means persistence here. This is for any kind of shocks. Second, since 1 over phi t is martingale, that means that phi t, the level, will be a sub-martingale with respect to this measure, which means I will have a positive drift with respect to this measure. Okay, what about the physical? So I will have a positive drift in distortions over time. What about the physical measure? Well, the physical measure depends obviously on the covariance of my excess burden of taxation in this measure. Typically, it's negative, so typically I expect also a positive drift with respect to the physical measure. That's about my exponential case. Let's go to the power case, very standard. These are the 2 main cases that have been treated in the literature. Power case, this eta t plus 1 has again an easier formulation, but the interesting thing is now it's an innovation in debt and marginal utility units, scaled properly with continuation values, fine. With respect to this kappa measure I had before, which means again, I have this kappa measure, my 1 over phi t is martingale with respect to a kappa measure, which means, it's also, I have a positive drift with respect to this kappa measure, and typically I expect also the positive drift also with respect to the physical measure. The third case, the logarithmic case, I actually get that 1 over phi t is a martingale with respect to the physical measure. I don't even have to think about physical versus the other measures I had. So I always have a positive drift. So what we get here is a very strong result that on average, you postpone distortions in the future. That's the backloading of distortions for my 3 cases. Going back, let's talk about taxes. Let's try the tax rate as a function of what? Let's try the tax rate as function of phi, which is the excess burden of taxation, and staff. What is the staff? These are all the elasticities of the marginal utility of consumption and the marginal utility of leisure, marginal disutility of leisure. So these are on and cross elasticities. This is if we go to the time additive case, phi is constant, and this is the typical formula that just shows you that if I have constant power, if I have power utility in consumption and power utility in leisure, power utility in labor, power disutility in labor, if I have constant free elasticity, then my tax rate has to be constant. So phi is always constant. The tax rate may not be constant because in the time additive case, because this elasticity may be time varying. Even if they're time varying, they don't vary much. It's like variance of 10 basis points typically, or 10, 20 basis points. But also for the constant free case, these things are completely constant. So you have a perfect tax move. What happens with your cash utility? So when you take this utility function with a constant power utility, power in consumption and power in labor, which implies constant labor tax in the time additive case, that's my tax rate in the recursive utility case. So the inverse of the tax rate follows effectively the same law of motion that I had before in terms of phi. In that case, tau t moves 1-to-1 with respect with phi t. So all the results I talked about, taxing, putting more distortions in good times versus bad times, translates 1-to-1 to the tax rate. And also the results about the drifts I talked about, that translate in terms of the tax rate for this nice case. Okay. We found all these things, so everything you knew about tax smoothing was not hold, with time additive, the time additive case does not hold when you add some aversion to volatility in future utilities. That's effectively the result here, and have all these properties. And it holds very generally for any kind of, it's not something special about exponential or power or anything. Okay.
5 minutes.
Yes. What happens with incomplete markets? I will be short in incomplete markets, so I will be brief. What happens with incomplete markets? You may think, okay, all this time you have been talking about effectively manipulating stochastic discount factors. when debt is not contingent, maybe there's less room for manipulation of the SDF. So you may think something like that initially. So let's take my thought experiment that I had before. Assume we have a two-period model. I have a low and a low shock and a high shock, and my planner at time 0 issues non-contingent debt. Okay. So in good times, the planner in that case, so in both cases, good or bad times, the planner will have to repay the same amount of debt. It's non-contingent. So in good times, the planner now will have to tax less to repay debt and finance these low government expenditures. In bad times, we'll have to tax more to repay this debt. Okay. How much, though, non-contingent debt does the planner issue? With expect utility, you issue so much debt in order to make the tax rate on average constant across good and bad times. With recast utility, before I was telling you, hey, don't make it. I was telling you tax more in good times, tax less in bad times. Here I was saying good times you tax less, and bad times you tax more. So you may think, oh, when I go to recast utility, I may have a counteracting force that negates what I knew with the time added utility from Iagar, Sargent, Sepal. Is this so? The answer is no. So because we always have to think about the price manipulation. So with recast utility, what happens now is I will be using my continuation values as a planner in order to make the average SDF, which is just the inverse of the interest rate, large. Now, that way, I will have a high price. So I will make my price of government debt high. I'm selling this debt, so I get a lot of revenue. I can tax less today. So how it's going to work? The way it's going to work is instead of putting more tax distortions on events with high debt in marginal utility units, now that is not contingent, and the planner will be putting more tax distortions on events with high marginal utility, which will mean I will tax even more bad times with high marginal utility. So this will effectively amplify what you knew from that time at the case. And you run larger surpluses, so you issue more debt and you run larger taxes in bad times than the time at the case. Okay, let's see the algebra. Let's take the optimality condition with respect to my debt in average marginal utility units. And let's take initially the time additive case. The time additive case is the Iagar-Sargent Sepala, which effectively is, before I was showing that with complete markets, phi t plus 1 is equal to phi t. Now you make the average excess burden of taxation constant. Average with respect to what? This variable xt, which is just the risk-adjusted measure. So with complete markets, you keep distortions constant. Within complete markets, you keep distortions on average constant. That's what we knew. Here, what will happen is, instead of having an equation that will determine the average excess burden of taxation, with recast utility, I will have something that determines the inverse of the average excess burden of taxation. And will be this equation here now. I will have the inverse of the average excess burden of taxation tomorrow is equal to the inverse today minus, you can ignore this term, does not really matter, psi t, think of the psi t, remember the psi t, times debt last period. And this measure n is just risk adjusted and continuation adjusted, continuation value adjusted measure, this n plus 1. So what's this xt? Before, I had this variable eta t, this innovation that was debt in marginal utility units scaled by the coefficient of absolute risk aversion. Now it is just marginal utility scaled by the coefficient of absolute risk aversion. Why? That is not contingent, it went out. It's this BT minus 1. So all these things are effectively the terms that determine the marginal revenue part in my first slide. So now my marginal revenue will just depend on the relative marginal utility, which will completely change the incentives of where you tax. It makes sense, by the way, why it depends only on marginal utility, because what you care about is now average marginal utility, and that's not contingent. So that's why that doesn't play a role anymore. It's only marginal utility. So fine. It will be obviously 0 for the time-added case. Okay, and then I would go back to the Iagar-Master-Sutton separal result. This term would be 0, and then I invert it, and I'm back to the average, make tax distortions constant over states and on average constant. But now they will not be constant anymore. I'm expecting, I'm finishing in 30 seconds. Last slide. I'm expecting, margin utility to be high in bad times, low in good times, and therefore taxes to be on average higher in bad times and smaller in good times. So I think I said everything I want to say. Minimization of welfare distortions may means that you tax more events for which it's cheap to issue debt. But for that, you have to talk seriously about what is the revenue from the government debt portfolio. And for that, you need a serious theory of asset pricing. When you do that, then everything you knew about tax smoothing does not follow. And you effectively get amplification of the standard taxation and debt issuance motives. Thank you, Shetil, for being strict with me and stopping me.
All right, the discussant is Marco Bassetto.
So, well, thank you very much for, so let me get back to slide 1. Thank you very much for inviting me to this conference. It's great to be here. I very much enjoyed reading this paper. It's one of the typical Tassos papers. It's very deep, very well thought, also very dense. So not an easy read, and I think you got a taste of that during his presentation. So I have 10 minutes, so I'm gonna try to not focus as much on the algebra, but give you an idea of the key concepts. And then, Tassos provoked me here a little bit because the title, A General Theory of Tax Smoothing, led me to obviously think it can be more general. And so that's where I'm going to point out a couple of things where you can do that. So this is a paper that studies optimal labor taxation with either complete markets or only risk-free debt, real debt. And then there are two possibilities. That's commitment or no commitment. And as Tassos mentioned, more precisely, no commitment means that he's looking at smooth Markov perfect equilibria. And general recursive preferences, such as sensitive preferences and so on and so forth. The overarching theme of that hopefully you got from Tassos' presentation is that there are two key forces that drive optimal taxation across all these environments. And that's why this is a general theory and can be more general. That's one, that is the desire to equalize marginal distortions over time. The cost, marginal distortion means we don't have lump sum taxes. So we're gonna have, if we want to get one extra dollar, let me make it one extra good, of resources out of the households and into the government budget, we have that comes at a welfare cost for the economy. And that marginal cost should, that's one force that says that marginal cost should remain constant over time. We want to spread it out. But there's a second force which comes into play, which is asset price manipulation. So the government is a big player by its choice of taxes. It's affecting asset prices. One of these assets, in fact, the only one that is in this specific model, but the idea is more general, is government debt. And so you want to play with that to reduce the required price and value of taxes that you're gonna need to raise to repay this debt, and that's one of the things that is in play. So I'm gonna argue that the same forces arise in more general environments like multi-period debt, other sources of market incompleteness, and even heterogeneous agents. And so you can reinterpret. So Tassos can use his paper to make a point that all of these have this overarching feature that that he's talking about. So I'll go back to the textbook example, the Lucas-Tocchi economy, where there's output produced 1-for-1 with labor. So like in the paper, there's only consumption and labor. I've made my preferences super simple for now. And actually for the algebra, that's as far as I'm gonna go. So these are gonna be isoelastic preferences, and there's some initial debt, but notice that I wanna focus on the fact that this initial debt, like in the original Lucas-Tocchi, can have a maturity structure. It could also be state contingent in principle. So, you know, you have some debt due in period 0, some debt due in period 1, some debt due in period 2, and so on and so forth. And they're all, this is all that is outstanding as of time 0 when the planner, here I'm looking at commitment, when the planner is solving its optimal problem. You can get the Ramsey first order conditions. It's entirely standard. What are the two key things that I want to emphasize is the two forces. So in the Lucas-Tocchi, the smoothing effect is very transparent. It comes from the fact that you have a single excess burden, which is this multiplier phi. And it tells you that the marginal marginal cost of raising that extra unit of present value should be constant across all states of nature and across all periods of time. And that's why it's a phi without a time t subscript. Now, if we didn't have initial debt, that would be the only force. Then you can put together the first order conditions for consumption and labor, and along with the fact that the tax you can prove is given by this formula, and you find that the tax is going to be constant across all states and over time. This is special, of course, to these isoelastic preferences. Normally, income and substitution effects will play and will mean that in order to keep the marginal distortion constant, you don't need necessarily the tax to be constant, because if government spending varies in the background, the two are not going to be related. But for these preferences, which make our life simple, taxes would be constant. Then you can see the second force in play. So suppose, so Tassos deals with 1 period debt. Then in the initial period, that's something special. That's this initial level of debt. You want to use asset price manipulation to reduce the burden of that. So now if you think about it, so if it's initial debt, the way you're you'll want to do it is you're gonna have to roll over some of this debt. You want to make the cost of rolling in that over low. So you want the interest rate going forward to be low. How do you make the interest rate low? You make let me make sure I'm getting things right. So yes, you want the interest rate to be low. You're going to make the marginal utility today low. Am I getting mixed up? So you can see here. So BT is going to make things, so this is going to be a positive term here. You're going to have to reduce this. So you're going to have to increase consumption to reduce the marginal utility. How do you increase consumption? You decrease the tax rate today. And essentially what you want to do is you want to make time 0 goods cheap. Why do you want to make time 0 goods cheap relative to future goods? Because you have all these initial liabilities in time 0 goods. But of course, if those liabilities, if instead of having debt due in period 0, you had debt due in period 10, those you'd want period 10 goods to be cheap. And so that's a second force in play in the Lucas and Tocchi environment. It gets a lot more exciting in the other applications that Tassos is giving us. So that's go through them. And you know,
2 minutes.
there are
2
three
minutes.
of them.
2 minutes,
Wow.
Marco.
Okay, fine. I'm gonna have to be quick then. So one is Tassos has shown you how it works with non-state separable preferences, and here the key is the level of utility in a state affects the value of resources in a different state, and that's the usual issue with you know, with non-state separable preferences. That's exactly what it plays. And so you're going to get that effect. The price manipulation is going to give you the martingale formulas that Tassos gave you. That's coming from the fact that now you have this additional instrument to manipulate things. If you have only risk-free debt, then in the case of state separable preferences, you get this expression. You try to smooth things as much as you can. And here I want to make the argument that given that you're going for generality, don't focus just on risk-free debt. There's other papers like Bandari, Evans, Golozov, and Sargent that have looked at arbitrary payoffs, but exogenously given. And you have a theory. That theory extends and gives you this formula for tax smoothing, and that gives you again the same principles of tax smoothing and interest manipulation are at work there, and give you an idea of a theory of optimal hedging and so on, and that's encompassed in what you're doing. Finally, a word about actually two things. One is quickly time consistency. I showed you here that there was this force that made you want to devalue initial debt. If you have time consistency issues, that force is going to be there every period, and that's going to give you an incentive to increase debt over time. That's another illustration of the general principle that Tassos is giving. You can also have embedded heterogeneity in here, and now it's rather than having just marginal redistribution from the government to the agent, you also have marginal redistribution from different classes of agents when you manipulate interest rates. And there are papers that have studied that. I have one, and then again, Bandari, Evans, Golozov, and Sargent do that. One paper is the one that one of the two that I've already cited. That the second one is a different one. But these ideas are floating around, and you're bringing them all nicely together. So that's a nice thing. So conclusion is you illustrate nicely these two guiding principles, push them further.
Thanks. Tassos, do you want to answer quickly, and then we take some general questions?
That was great, Marco. Thank you so much. And I know it's dense. Yeah, I know. I'm really sorry for that, but yeah. Yeah, effectively, it's exactly what you said. You always have these incentives to play with the value of your government debt portfolio. What you refer to with the debt in the initial period is the typical thing we have in the incentive to devalue initial debt always in marginal utility units. It happens on the commitment. Yeah, okay. With long-term debt, yeah, it holds more. If you had short-term debt, it happens all the time zero. But because you stick to your promises in the future, if we didn't have sticking to your promises of the past, it would show up every period, this incentive to devalue debt. But yeah, that's one mechanism. The other mechanism is these elasticities in the tax formula that I showed before effectively capture how you want to manipulate also future debt, the value of future debt through period marginal utility. And now you have the third channel now is how you manipulate the value of debt through continuation utility. So all of these things, as you said, are in there. It's always an incentive, yes, try to make it cheaper in order to reduce the tax distortions, but you're completely right in saying that. I like the, as we have, I like your suggestion a lot about using the richer environment of BEGs. That would be great. And I do think it will come out something that is not, it will be, it was something nice may come out from that, and generalization of the form I had. And absolutely also about heterogeneity. Yeah, maybe there are too many things going on, but yeah, I don't know. We'll talk about that in the breakout room. Thank you so much. I don't know if somebody wants to ask any questions.
Manuel, go ahead.
It was a nice paper, Tassos. Just a quick question, or maybe a suggestion. So just from the work of, again, Amol and Mike, sorry, Tom and David, can you think about the implication for maturity structure of government debt in an incomplete market version of your model with this recursive utility, and whether it delivers more reasonable portfolio choices that will usually arise in these environments?
It's a paper I want to write. I expect, okay, it's a paper I want to write, optimal fiscal policy with regards to utility, exactly that. And then optimal maturity structure government debt with regards to utility. I want to write that. Of course, before you write that one, you have to understand even just with short-term debt. And that was why I started with that. And then in principle, you may expect that having, what happens, something a little bit peculiar here. You have I have another paper where I have looked at the gas utility and analysis of fiscal policy, right? So what happens is that you have a more plausible model of returns. But when the optimal debt portfolio that the government is choosing and that the optimal return effectively that the government is creating, the government here is creating a return, a risky security called government debt that's taken, synthetic, the portfolio of all these state securities. What comes out from that is something that does not look at all like the data. So you put a richer model of returns, and actually the optimal policy that comes out of that does not look like the data, which tells you that, okay, of course, we don't use the proper, in the data, we don't observe necessarily optimal policy, but it tells you that maybe what we observe in the data is even worse than you thought. So in another paper I have done like what Steen was talking about before, the Cambridge decomposition. So Hanno, Sevin, and Anya Byrne have a decomposition of the US government budget about how they have absorbed fiscal shocks using returns and increase in tax revenues. So in the data, you absorb government spending shocks by just increasing something like 70% tax revenues and reducing returns only by 10%. Look at Stock, it tells you it should be the opposite. You should use much more returns versus tax revenues. In a model with regards to utility, you should use returns even more than look at Stock. So what I'm saying is having more plausible model of returns, doing optimal policy, who knows what will come out. Now, but I think it's a paper to write for sure, because definitely has, it's an answer we should, it's a question we should answer. When you have a richer model of return, all the models about the yield curve using regards to utility, there's a reason why they're doing that. So obviously we have to think about that. I completely agree with you. One big author.
Can I ask you a quick question, Tassos? So in the recursive preference, obviously nest the CRA. So you looked at the case when the risk aversion is high and the temporal elasticity substitution is above 1, I guess.
Effectively, my concavity in Macerno equivalent, this is what captures.
So that is a model that if there are shocks to future consumption growth, you get a higher risk premium. Now, there are other ways to get alternative ways to get serious asset prices. For example, if you have if there are changes in the probability of catastrophe. Okay. Now, so it's obviously it's not written in stone that it goes that the intertemporal elasticity substitution is larger than 1. Imagine we're lower than 1. Would everything you said be flipped?
Wait, if whatever I said, it's about, again, yes, I had the concavity, I had the concave surgeon equivalent. Conditional on this recursion making sense, by the way.
Yeah.
Let's take my first order conditions again, the same. What I had, just change all the signs. I had the coefficient of absolute risk aversion. Let's call it a coefficient of absolute, how would you call it? Risk loving. all these things.
Well, you know, risk loving. I think we should.
By the way,
I think we shouldn't necessarily just tie ourselves and accept the Bansal-Yaron. So imagine, for example, imagine somebody asks you, for example, would you like to know the day you die? I think most people would say no. No. That suggests.
I mean, it's a tricky question what you're asking me now. I don't know. And again, I as you see, all the results I got, I did not specify the small u of consumption that's function of the composite good of consumption and leisure. The IES enters there. I did not specify that. So I don't, you know, but obviously, typically, you need to generate to match asset prices. You need to generate a premium for the areas of uncertainty. Fine. You're saying is, you know, you don't buy it. Fine. It's
no, I'm not saying I don't buy it. I think your paper was very clarifying, but I don't necessarily sell myself as Bansal-Yaron.
Yeah. In any case, what I'm doing is take this as given. Does it matter for policy or not? And obviously, it matters a lot. I hope I convince you, but in any case.
Absolutely.
Okay, good.
Should we take a couple of minutes break?
Yes, breakout room, because then we have Tom.
Tom is there in 3 minutes exactly.
We had not put. I'm sorry. Yeah, breakout room is after Tom. Sorry. Yes, Tom is in 3 minutes, so we can have a break for 3 minutes.
So a quick coffee, and then Tom. We're looking forward to it.
And then we can have a breakout for later.
Yes.
No, if somebody was in.
Never mind. All right.
Yeah.
What are you assuming by my bequest function on whether I want to die or not? Do you assume that I care about the children, or it's just utility? I get it.
No.
Utility when I'm dead, or it falls because
no,
I'm trying to define risk averse with respect to that, or even.
It's a much simpler point. It's just that if you have an temporal elasticity substitution larger than 1, you would like earlier resolution of uncertainty.
I know. That's the characteristics, but that's for a shock to the utility function at some point in the an uncertainty on a payoff at a point in the future. But the probability of death is a shock to potentially either my discount rate or the bequest. So it's not the same as the Krebs-Porteous experiment. No, the Krebs-Porteous, if I have the utility accrued at different points in time, and I have uncertainty at a date or an earlier date. But death, I mean, if you have an infinite-lived agent linked by Danis, you're completely right. But what if I say that death is literally minus infinite utility no matter what? Then can you use Krebs-Porteous? I don't know. I don't think early resolution.
I think Krebs-Porteous is very weird use with that, because it would have implications that your portfolio depends on whether you believe that you're going to go to hell or heaven.
Exactly, that's what I was trying to say. Whether it's minus infinity or plus, you see what I mean, Chadil?
I see.
Sorry, I was being nerdy. I'm being nerdy, but anyway, sorry.
Yeah. I have to think about that.
You have to tell me something about the bequest. What happens when I die? Do I care about the guys after? Is it hell? Is it heaven?
Yeah, because it is really it's not the resolution of news per se.
Exactly.
It is the value of consumption in those states.
Yes.
That's your point.
Yeah.
So if you don't care about your children, I guess. So if you care, imagine, if you care about your children in like a perfect dynastic way, death should be irrelevant. No, but if you imagine you don't care about your children at all.
Well, I thought I care about my children, but it's like a utility shock in the period I die or something, or then you could.
But it has to be the utility. Marginal utility consumption. So it must. So imagine you just have zero marginal utility in that case, I guess.
The problem is it's not a marginal; it's the level of utility that matters, and that's what makes it not so interesting when you're thinking about the death state.
Okay, you guys know this much better than me, but I should shut up and Tassos should take over and where is Tassos? Tassos, can you take the lead?
we are extremely happy to have Tom Sargent here to give our plenary lecture. I don't need to make an introduction for Tom. He's Tom, he taught us, and we hope we'll continue learning from him. Tom, the floor is yours. You have to unmute yourself.
Can you see my slides?
Yes, we can, and we can also hear you. Excellent.
You can hear me too. Can you hear me?
Yes.
All good.
Okay, good. Okay. So this is going to be I would say a low tech talk, or actually, I think you might say it's a no tech talk. I'm just going to show some pictures and use some words. I will use one equation. Nevertheless, there's anytime I make or anybody makes a picture, you're using some data reduction before you even got to the picture. And there's some decisions made that are connected to decisions and issues that were talked about earlier today in the whole conference. So one is about filtrations. One is about common stochastic trends and co-integration. And I'm influenced by a 2012 Econometrica paper by Lars Hansen about multiplicative stochastic processes. And that's going to dictate the way, that's going to influence the way George Hall and I arrange data. I'll just say that. Okay, there's going to be, okay, so it's going to be motivated by two ideas from two people. Keynes' statement, what a government spends, the public pays for somehow. And then a Gary Becker idea, beautiful 1962 paper, that budget constraints alone put restrictions on behaviors and outcomes. And I'm just going to describe, I'm going to show you pictures from budget constraints and balance sheets. Any remarks that I make might go beyond that. Okay, so let's see how we go. Okay, so the title of this paper is Three World Wars. World War I, World War II, War on COVID. Because of some criticisms that George and I received about this paper, about questions, helpful questions about whether there were departures from, whether the pictures I show you depart from earlier US patterns before 1900, because there were differences. You know, before 1900, maybe the gold standard was different. For much of before 1900, US didn't have a central bank. US was a net international debtor most of the 19th century. There's going to be issues about money versus bonds and poisoning and sustaining reputations of money versus bonds that were big in the 19th century, maybe not in the 20th and 21st. So to answer those at the end, I'm going to show you some pictures from three pre-1900 wars: the War of Independence, War of 1812, and the Civil War. Okay, so here we go. So what are my three post-World War, post-1900 World Wars? World War I, World War II, and the war on COVID. And so this is a conceit. Not everybody would buy. We're gonna try to do pattern recognition or pattern exposition to give you analogies about the war on COVID and the earlier two wars. And this is George and me imagining things. George and I imagining things. So what are the common? I'm going to tell you about some common patterns that George and I think we see in the charts I'm going to show you, and that are shared with the war on COVID. there's an adverse worldwide shock. There are what we call negative labor supply shocks. Well, I was in the army in the form of in the world wars, in the form of taking soldiers away from civilian employment and telling them to do nothing much of the time, versus mandatory lockdowns that diverted workers into unemployment and voluntary withdrawals from the labor force during the COVID panic. And then there were extensive government restrictions on domestic trade and domestic and international travel and trade. So here's a picture of our shocks. I'm going to take you through some pictures fast. You can find them in the paper. This is a percent of the population that were in active duty military. You see World War I, World War II, and the war in COVID. And the war in COVID is not active duty military, it's insured unemployed, insured unemployed. Those are our shocks. The patterns we see that we observe. I want you to watch for these patterns in these pictures that I show you. Their government outlays spiked during World War I, World War II, and COVID-19. They were largely financed. I'll modify the term largely when I show you some figures, by issuing interest-bearing debt and base money. Is there a difference between interest-bearing debt and base money? We'll come back to that. After World War I and II, tax revenues remained elevated so that the government ran primary surplus for a number of years. Furthermore, after World War I and World War II, you can ask me later whether this was a 19th century pattern too, but after those two wars, there were permanent increases in federal expenditures as fractions of GDP. And this relates to Sten's random walk and possible shifts or random walks with Poisson components. Okay, we'll come back to that. And I have Lars as a multiplicative process staring me in the face when I look at these graphs. Another thing is, as well, the last one is the Federal Reserve. The Federal Reserve System supported federal bond prices and expanded its balance sheet in all three wars. I'll show you pictures about that. That's what I want you to watch for. Okay, so now I just show you some pictures. Okay, so this picture, I could teach half of an undergraduate class, maybe a graduate class, just looking at this picture. So the red thing is total tax collections, and these. Whoops! What happened? Oops! I don't know what I'm doing. Okay, the red thing is total tax collections. The blue is total government expenditures. So look at World War I, a surge in expenditures. Temporary surge in expenditures, followed by, look at this, kind of a permanent increase in the level. Taxes grew during the war. They came back down in the 20s, but they remained higher and there was a surplus. Then the Great Depression starts. This is the Great Depression. So deficits during the Great Depression. You could compare that with the, you might want to, we could spend a couple classes in my undergraduate or graduate class comparing this to the financial crisis. They're kind of comparable. During World War II, same thing, big surge in expenditures. And then they come down after the war, but they come down to a persistently higher level. So there's a permanent increase in the level of government expenditures after this war shock. And then there's a temporary surplus and so on. There's the Clinton years, Here's the Clinton years, and so on. And then here's COVID. Here's COVID. And we're stopping. Here's what's happened so far. And then these different colored lines, these are projections from various official sources. Should you trust them? Remember what Sten said earlier. Okay, so that's our one picture. You look at this and you could say the first thing you might say is Barrow looks pretty good right here. Look at Barrow. So okay, so we'll keep coming. There's the primary deficit. It's just the first difference of that. Everything is scaled. Everything is scaled by GDP. I'm using this common stochastic trends notion. Some of my friends at Minnesota said, oh, you should never do that. You should Hodrick-Prescott filter, and it would make a big difference. Yeah, it would make a big difference. Okay, here's another figure. Here's the par value of US Treasury debt. Now, when I say par value, that's the debt that's recorded on lots of the government accounts. And I'm going to come back to the distinction between par and market value later. So there's I'm going to show you. I'll show you like there's the par value as a percent of GDP. The blue is domestic investors. So that the total is the total. There's some other holders. You know, before World War II, it was mostly domestic investors, and then these the Federal Reserve. Actually, Federal Reserve was founded. Go read the some of you that work for the Federal Reserve. Go read the original act. You weren't supposed to touch Treasury debt. That was the real Bill's doctrine. You could buy other stuff, but not Treasury debt, and you didn't. And during World War I, you engaged in a subterfuge to buy it while complying with the law. I'll just tell you that. But then the Federal Reserve starts buying it after World War. Actually, it starts after the law was changed. So you didn't have a subterfuge. And then notice what's happening here. And here's what's happened in COVID. Okay, here's what's happening in COVID. Here's government agencies. And as someone noted earlier, here's foreign investors. Sten mentioned this. Okay, this came up earlier. Now, if you look at this graph, look carefully, and let's say you're teaching this class and you're saying, do you notice this last part? Look at the last part. That's the par value of Treasury, the debt GDP ratio, measured a certain way. It's come down in 2021. So why did it come down? Well, first, nominal GDP grew 11% last year. The par value of the debt grew only grew 7%. Federal Reserve holdings grew a lot. It grew despite that. Okay, so a little bit of inflation has done its trick. Okay, so we'll come back to that. So here's Treasury debt at the start and ends of wars. There's a table about this. We record this. I'll just, if you're interested in this, read it, and you could see how much the ownership is how much debt's been issued in COVID. A huge amount. Look at this huge amount, and the Federal Reserve has bought a huge amount of that. So look at this number. Okay. So now George and I spent a lot of time staring at Federal Reserve balance sheets. Okay, so you could look at those. That's during World War I. It's kind of interesting how the debt, how the government financed the debt during World War II or World War I. They use this subterfuge. It's called a borrow and buy process. That's the Federal Reserve balance sheet during World War II, during and after World War II. See what happened. You could see the assets of the Fed. The Fed's buying a lot of U.S. securities. It's supporting the bond market, as was said. And you can see what the liabilities are. Lots of deposits. And now here's an interesting one. And I got early wonderful comments, very critical comments by Amador and Aguiar, independent but correlated comments. And they prompted they prompted about a month of work to write a paragraph. Okay, so here's the and about something I'm going to show you. Here's the Federal Reserve balance sheet. You could see what happened with COVID. Actually, it's relative to the financial crisis, it's huge, and relative to those other wars, it's comparable. Here's the liability side. So we know that the Fed bought, well, it bought a couple. So we could spend a lot of time on this. We could spend a whole class on this. So the U.S. after the U.S. So there's 2008, and there it starts buying stuff that Greenspan thought you should never buy: private securities, mortgage-backed securities, and other private securities. It starts buying in 2008, and as part of its quantity, it ramps it up in the war on COVID. And then, so how did it pay for them? So, well, it prints some more notes. Those are the green thing. It issues a lot more reserves. So a big jump in reserves, and then increases like this. What it does is lots of those Treasury securities it buys, the Treasury just, look at that blue thing. The Treasury just keeps it in the Fed. It keeps it in the bank. Doesn't spend it right away. So huge increase in Treasury deposits, which are gradually run down. They're gradually run down. Okay, and then, okay, that's fine. But then look at this. Something happened in March 2021. Well, a couple of things. Federal Reserve reserves flatten out. They don't increase, even though the Fed's buying, you know, the notes don't increase, the deposits don't increase, and this red thing goes wild. What are those reds? That's something the Fed said it wasn't going to do. Greenspan would never have done that. Read Alan Meltzer's book, and this is what, okay, we had to figure out to understand what Amador and Aguiar were complaining about. These are reverse repos, and they exploded in March of 2021. And there's an interesting story. You could look at the paragraph. These reverse repos, I'll give you a short kind of slanderous story. The Fed has now become a lender of last resort, or a central bank to money market mutual funds, and it's doing this because it wants to protect the repo market. That's what it views its job. So so the Fed is now a central bank that's given the shadow banking system, which is what the money market mutual funds are, access to the Fed. That's what's going on there. So it's a big change with this red thing. Anyway, that's all concealed behind this, or concealed or revealed behind this balance sheet. There's a story there. Okay, now here's a graph. Do you want to direct your attention to? This is the par and market value of Treasury debt held by private investors. Okay, so it turns out that George and I wrote a paper on this 11 or 12 years ago. The Treasury accounts don't match the way they record the government debt and the interest payments on the government debt don't match what's in macro theory. They don't mark things to market, and the way they value government debt is I'll just say peculiar. And they do it that way, as far as I can figure it, they do it that way because Alexander Hamilton told them to do that way. I'm gonna come back to that if I have time. I'm gonna make sure I have time. Okay. So what George and I did is we just used market prices to value the debt, and that's what this blue line is. And what's remarkable is the blue line and the red line, the par value, line up a lot. And kind of there's no reason they should, but Chari gave us the only theory we ever heard about why they might line up. There's a footnote in the paper about that. So these green lines and the blue lines are because Aguiar and Amador made us think harder. So after 2008, the Fed pays interest on reserves, and it also pays interest on reverse repos. Okay, so what this green line is, the green line is the par value of Treasury debt plus interest-bearing reserves plus reverse repos. That's what this is. Okay. However, if you look, that's what the green line is. And kind of like this previous line, it makes you think about real bills. This graph makes you think about real bills. You know, the way to defend quantitative easing and the Fed buying stuff it wasn't supposed to buy in 2008, you could say, oh, well, in the original act, that's what it was supposed to buy. It wasn't supposed to touch the Treasury stock. So you could have that discussion. Okay, so coming here, a part of what the Fed buys is real bills. It's going to show up in these budget constraints I'm going to show you. So that's what this blue line is. It subtracts off Fed holdings of private assets because those are Adam Smith real bills. They're backed by private stuff. Anyway, so that's what this graph is. Okay, here's a consolidated government budget constraint. I'll let you stare at this. And what George and I are going to do is we're going to do some accounting leading up to an accounting of how it's going to be related to what Stan and also what various papers have done. We're going to give you a backward-looking decomposition of the dynamics of the debt GDP ratio. Ours is going to be entirely back-looking using market prices. Okay, so we'll lead you through this. G is government expenditures, purchases. Those are the interest payment. Not everything's nominal. Everything's nominal. Nominal interest payments. Those are the nominal purchases of call them real bills, private assets. Those total tax collections. Those are that's the increment in the nominal value of government debt. They're printing new debt. You get some earnings on your assets. You print some more reserves, and that's other means. So what George and I are going to do, we're going to divide by Y in the common trend spirit, and then we're going to rearrange. So what do we get? We get government spending. On the left-hand side, we get government spending ratio to GDP, net interest payments, net meaning, you know, subtract off the earnings on government assets. You know, Ricardo, there's an issue, RB versus RA. You'll notice we take a stand on that. Who knows who'll like it. Those are your asset purchases. That's what you do. On this side, there's tax revenue. Okay, so now the question is, how do you pay for it? You tax, you grow your debt, you grow your money, you do other means. And then you do some other things, secret weapons. You dilute the debt versus real GDP growth. You debt default via inflation. And by the way, the US has defaulted before. Sebastian Edwards' book, American Default, went to the Supreme Court. He said it was okay. It's a fascinating book. Roosevelt explains why they defaulted. And then there's this nuisance cross term. So that's our accounting. That's what we're going to do. So now I'll just show you some. Okay, so now what I'm going to do is we're going to use this accounting to show you. We're going to show you how. We're going to do one more transformation. We're going to show you how the U.S. financed surges in government expenditures associated with each of these 3 world wars. Okay, so to do that, we're going to normalize in a certain way. So what we're going to do is we're going to form a baseline of everything. We're going to form a baseline by taking a 5-year pre-war average of all these ratios, and I'm going to draw them. So do you see the red lines? And then what I'm going to do is I'm going to take the integral between the it's like consumer surplus. I'm going to take the integral between the, oh yeah, there's the integral. I'm going to have those are measures of the surges. Those are the measures of surgers. And then I'm going to say, well, how are those things financed? Like Keynes said, you read the rest of Keynes's quote. Well, money, money, inflation, tax, issuing more debt or taxes. Okay, so here's our table. Based on this, this is kind of everything, including, well, I'll show you. So there's World War I. So there's government expenditures relative to 1 year's worth of GDP. The World War I cost 40%. World War II, 120%. COVID-19, 21%. That's what's happened. And then so on this side, so on this side, we bought some assets. This side, that's the left side of that budget constraint, and here's the right side: tax revenues, debt growth, money growth, and GDP growth. And then these are percentages. Underneath here are the percentages. So that's World War I, and you can look at World War II comparisons. I'm going to give you a summary later. For me, there's too many numbers here, but I'll show you some summaries. Okay. That's the war on COVID. Okay, so here are my Aguiar Amador choices. The one question is how are we going to treat in these earlier wars, the government's not paying interest on reserves or money. In the war on COVID, they are. So now should I count reserves as money, and should I count reserves as bonds? And so we're going to do this decomposition both ways. Oh, there's a mistake here. Oh yeah, no, there's not. Reserves are bonds, reserves are money. So here's what you find. A war on COVID, tax revenues, less than 4%. debt growth, if reserves are money, debt growth less than 2%, money growth 92%. That's how we finance it. GDP growth, this is even after that is 3.7%. This is even after that drop in 2021, and inflation 11%. The decomposition goes different if we do we count reserves as bonds, and now debt growth is doing a lot. This is Marco's question about the difference between money and bonds. I'm going to come back to that. I'm not going to add any more light on it. Okay, and then here's what we do. So now I'm going to show you a couple of pictures, and then would you guys tell me when I'm running short of time? Tell me when I'm 10 minutes short.
Okay, you have 30 minutes. You have to, yeah. So you're good. I'll tell you 10 minutes.
Well, I'm going to end early. Okay.
Okay. Yeah. So you have plenty of time.
Okay, good. Okay. So so George and I have some graphs like this in some earlier papers, but here's what I'm going to show you. Oh, by the way, I showed. I have friends at the IMF, and my friends tell me this analogy between the COVID war and these other wars is completely off base. So I just say that as they're respectable people. They look at a lot of numbers, they look at a lot of history, and they don't like this analogy. Okay, so I say that as a consumer warning. Self-criticism. Okay, so what this is this is the lateral log of the consumer price index during and after wars. So we start this thing at we take logs, so 0 is 1. We start it right at the beginning of the war, and here's what happened in World War I, and there's an interesting story. Here's what happened in World War II. Okay. So I could teach a class on this World War I one, and I'll come back to this one. So World War I, and the blue one is COVID. I'll just say the blue one is COVID-19. And what you'll notice is that wow, COVID is it's right on top. And every time we add another month, we hope. So the IMS view is this is a coincidence, and this is going to come back down like this. It's not going to look like that. It's going to look like this. Okay, World War I, interesting story. This is I'm not going to. So the years. So what's in here is the year. So look at this graph. Here's World War II. This is obviously the Great Depression, and actually, this is when Roosevelt got in, and he defaulted on a bunch of U.S. debt and changed the unit of account, basically from gold. He revalued gold. And the reason he didn't want that is there was a force. I'm going to tell you about this force. There was a force, because we were on the gold exchange standard. There was a force for this thing to keep going down to resemble another picture I'm going to show you later. And Roosevelt knew about this force, and Irving Fisher and other of his advisors knew about this force, and they told him to cut the link to gold to do heterogeneous agent. You don't have to call it new Keynes, heterogeneous agent, old economics, because his price level changes were redistributing debt between not only government creditors and debtors, but private creditors and debtors in a way that Irving Fisher thought was exasperating the Depression. Franklin Roosevelt bought Irving Fisher's debt deflation theory of recessions, and he tried to do something about it. Okay, so here's the real value of a portfolio of Treasury securities invested at the starts of wars. There's World War II. Here's World War I. World War I, after a few years. Well, so this is what concerned Roosevelt. anyway. So what you'll notice is here's what's happened so far in COVID. Okay, so here's my I'm kind of done with the paper. It's kind of a reader's guide to the paper, because I guess this paper, if anyone were going to read it, it's best read in private, looking at the graphs yourself, marking them up, looking at the numbers. So here's how the US government paid for those 3 world wars as percentage of total revenue. World War I, it was taxes, 20%, bonds, this much, money creation, this much. But again, this is tricky because of that subterfuge. Because a lot of these bonds, okay, go read about the borrow and buy program. It's kind of like, you know, put it this way: the Congress passes a law telling the Fed it can't do something. The Fed figures out a facility that lets it do it. World War II, more taxes. That was on purpose. Bonds, and here's money. But maybe this is also, you know, as people have pointed out, the Fed was supporting the Treasury bond market, and there were price controls. Who would want to impose price controls today? Go look at the law that Senator Warren and some of her friends are proposing. And here's COVID-19. And this is done post Amador Aguiar comment, where we're counting reserves as money, as bonds. Only what's striking about this is only 3.5% has been financed by taxes. Okay, so I'm just going to hesitate now. Okay, and I'm going to say, okay, so going to pause. Okay, so now here's kind of self-criticism, or criticism that we've assembled from people. Well, what changed between the 19th and 20th centuries? Which of these patterns are enduring? There were other wars, and there were other arrangements, and it would be interesting to know what happened earlier. So like Mike Bordo told us, well, what was the role of the gold standard? You know, and what, you know, Mike said, you know, very quickly, well, in World War I and World War II, the US was on a gold standard. In COVID-19, it's not. It's different. Okay. So what about the 19th century? Well, my short answer to that is, well, World War I and World War II, a purist would say, well, we weren't really on the gold standard. We were on a gold exchange standard, where, so go read about that, where there's a lot of devices to economize on gold and substitute paper for gold. And it's a way that's quote unquote more efficient, but also more fragile. So we're in the gold exchange standard. In the 19th century, we were really on the gold standard, no gold exchange standard. We're in the gold standard. So what was the role of the gold standard? Money versus bonds, and paying interest on the money. And what was the role of that in that today versus earlier? We'll come back to that. Paying interest on money, and what about price discrimination? Paying some creditors of the government different rates than others. You know, there's a theoretical argument for that. You know, one version of it is Keynes' how to pay for a war. But Bryan and Wallace have a formal model of price discrimination. And then there's a bunch of issues. They're founding issues about delegating and coordinating monetary and fiscal policies. You know, so I've used entirely a consolidated government budget constraint in all the calculations that I did. And I just made loose comments about coordinating or consolidating. So in the 19th century, well, we really didn't have a central bank. We had two national banks that lived for less or 20 years or less each. Andrew Jackson, he was 100% reserve person, a narrow banking person, and he took steps to do it. He and his party, we'll come back to that. There was no central bank. There was independent treasury. He didn't even want the federal government to keep. He didn't want the federal government to keep deposits in any central bank or any bank. So what the Democratic Party did, they succeeded finally in 1844. They put a law that there's an independent treasury, and what the treasury does with its receipts, it puts it in a vault, not in a bank, not in a bank, not in a clearing system. It's in the bank. So, and then who made quote unquote monetary and fiscal policy? It was Congress. Congress was consolidator and coordinator from 1844 until 1914. Okay, and then there's going to be this earlier conference George and I did, everyone was talking about credibility without defining it, reputation. And so from the 19th century, I'm going to show you some pictures and I'll tell you some stories about reputation, either poisoning or building or sustaining. And this relates to Marco's thing about M versus M and B. So, okay. So what are the three pre-war US wars? There were more wars. There were, I actually put this on because, a typical undergraduate at a school that I teach doesn't even know about there was a War of Independence. There was a War of 1812. They know something about the Civil War, but not very much. So there's the dates for you. There's the dates. Okay, and so in the papers George and I have about this, there's cast of characters. So in the spirit of trying to connect to NYU undergraduates that I was teaching, there's a cast of characters. So there's this musical, this rap musical called Hamilton. Well, Hamilton's going to play a big role here. James Madison, Andrew Jackson. Alexander Hamilton's for the NYU students who like rap. Andrew Jackson's for the Trump supporters because President Trump had a picture of Andrew Jackson for various reasons behind him. You saw it all the time. Andrew Johnson and Ulysses S. Grant. Okay, all these guys are going to play roles. I don't know. Okay, so I'm just going to show you kind of counterpart pictures about these three wars. So here's in the three wars. Now the graphs now, you got to look at the scale. It's 1800 to 1900. It's not. So here's these surges. There's some things about scales. There's the I said I was going to have three. Oh yeah, I said I was going to have 3 wars, but I don't have data for the Revolution. Here's the War of 1812. Here's the Civil War. But you should read these slides carefully because the scale is important. The surge was actually bigger than this because of the denominator. The Civil War, 11 of our states with 42% of the population left. Okay, so you're supposed to compare this graph to this graph. That's the way this is set up. Okay, and then here's, okay, now I could teach a subsequent class at NYU. You can tell I'm in the business of trying to find ways to teach classes without too much effort, which, so here's, having taught that 20th century class with the previous graph. So here's this graph. Here's this graph. Okay, this goes back to 1775. So the way George Hall and I have been spending a lot of time the last 15 years is we've been collecting these data staring at the graphs and asking them to talk to us. Okay, so here's the Revolutionary War. These are as percents of GDP. Revolutionary War was a huge surge in government expenditures. And here's the receipts. I mean, huge government deficits. I'll show you how they were financed. Okay, so then this is, okay, after the war. So, okay, you could tell a whole story here. This is the period when US has had two constitutions. We had the Articles of Confederation here, which is Ronald Reagan's dream, which is it's to create an institutional arrangement with, there's a very weak central government, has virtually no power to tax or spend or service its debts. And under those institutional arrangements, there were very low federal expenditures. And then there was a revolution in 1787, 88, where they wrote a new constitution that was designed to reverse Ronald Reagan's dream and to create a government that could tax and spend. And so look what it did. It taxed a lot more than it spent, and we'll see why. It taxed a lot more than it spent until it got into a war. And the reason it was doing that was, which I'll tell you about, it was doing it to service a bunch of debt. This difference is going into debt service, this difference here. So that's the beginning of our country. And what's going on here is a bunch of reputation built. Okay, so put my cards at the table. Theories of credibility in this. I should be a little careful. Theories of credibility in the Abreu, Pearson, Sticchetti, sustainable plans, Stokey tradition, are theories about sustaining an equilibrium, but sustaining a reputation, confirming a reputation, but they tell you nothing about how to earn a reputation. They may tell you a little bit about how to poison a reputation, but maybe not. But our founding fathers were actually interested in poisoning and sustaining some reputation simultaneously. I'll come back to that. And you know that built the stuff that the 19th century people capitalized on. Okay, so here's the War of 1812. There's a big surge of expenditures, big deficit, and then after the war, there's a big period of surpluses. A period of surpluses that extends all the way to for a long time. Look at that sustained services. That's very different from the 20th century. And then what happened for various reasons? Those surpluses were dwindled. And I was raised by a grandfather whose grandfather fought for the Union in the entire Civil War. So I was taught bad things about the Confederacy. So basically what happened before Abraham Lincoln took office in 1860 is the Southerners, the Democrats, poisoned the budget and handed Abraham Lincoln a very bad fiscal situation. So there were deficits before the war. During the Civil War, big deficits. And then look at the following. After war, there's big surpluses. And notice the following pattern. The following pattern is we pick this up. After the Civil War, big surge in expenditures drop, but they drop to a sustained level that's higher. This war, in terms of spending, there's a jump. There's going to be a jump in the there's a jump in the in a level of government expenditures that persists into the 20th century. Okay, so there's the primary deficit. This looks pretty good for Barrow. Okay, now here's a picture. You should compare this figure. You know, so look at this figure, and now compare this figure. Well, who's holding this thing is, as far as we know, domestic private investors are holding this. I actually think there's a new book that I got called Bonds of War. And I think there might be something wrong with this figure. I actually think there were some foreigners holding our debt. I know there were. But there wasn't a Federal Reserve and there weren't government agencies. Okay, so that figure is different. But now notice the following. This is par value. This is par value. Notice do you notice any? So this is a pattern recognition thing. You could show that. Do you know what's it? Wait, let's see if I do this right. Do you notice any difference between this? Well, maybe not. Look at that debt GDP ratio comes down after World War II. It comes back down after World War I. So it came down after each of these wars too. It came down, it went way up. It went way up after the, this is the par value. This is just the par value. Went way up during the revolution, peaked. And then with the founding of the country, it started going down. That's the War of 1812. That's this. Okay. I'll show you another picture. So now, too bad Chari's not here, because this is the par value and the market value of treasury debt held by private investors. And this, compare this with this. Look at the red and blue line that are just on top of each other most of the time. And I need Chari to explain that to me, because if you do the arithmetic, there's no reason the formula should match up unless somebody's jiggling some things in the formula the way Chari said they were jiggling. Okay, so here's the par value of government debt. And just in terms of the musical, you know, there's a legend or a myth, useful myth, that Alexander Hamilton redeemed. He serviced the interest-bearing Revolutionary War debt at par. He said, you got to do it at par. Well, he did, but he had big haircuts in interest rates. So there's the par value of the debt. It's just increasing. And then here's the market value. And then here's what happens is that market value, you know, this is the period of the Articles of Confederation before our Constitutional Convention. This debt is going like 20 or 30 cents on the dollar. And then the Constitutional Convention comes, and this is related to things earlier, Pierre Paula's comment. It becomes clear that Hamilton and his people are serious about servicing the debt somehow. And, you know, Hamilton, he rescheduled the debt. We can read about that in various papers. He gave haircuts, but you'll notice that the par value exceeds the market value. It continues to exceed the market value until after the War of 1812. And then once it does, okay, during this period, okay, this until the Civil War. Okay, and actually during the Civil War, after the Civil War, the market value actually exceeds the par value. And there's a story about that that's connected with interest rate risk. And parts of the Civil War debt that were issued by the federal government were callable, parts weren't. Okay, so it took a time for these to line up. So there's interesting stories, you know, and actually fuel for papers about the structure of debt. Some of the debt that was issued was really interesting. It was go read about the 520s. If you're interested in, yeah, these 520s were designed not by the people Chari says in the 20th century, but by Congress. And this new book about ways and means it leads you through parts of the negotiations by which these 520s were designed. It's fascinating. I can't resist. Here's what a 520 was. they financed a huge part of the Civil War. Okay, what they were is they were 20-year bonds. They were callable at the government's discretion after 5 years. Their par value was 100. 100 what? Well, $100. Well, what do you mean by dollar? Well, the U.S. was on the went off the gold standard, and there were gold dollars and greenback dollars. So the interest payments, the coupon payments, were 6% a year. They were 6% a year. That 6% of that 100 par value is payable in gold, and the principal, or the that would be paid either at the maturity date or the call date after 5 years at the government's discretion. It was ambiguous. It wasn't stated whether it would be paid in gold or in dollars. And that was decided by that, that's ambiguity. So to price that, you have to have a view about what's going to happen. And that unleashed a big political crisis after war. So there's history books about that. So why they designed it that way? Okay, so here's a friendly, you could say, pot shot or challenge for guys like Marco and Tassos, who were going to use Ramsey policy to model the actually to Manuel to say, oh, can you get a Ramsey theory of optimal debt structure? Well, it's going to be really challenging. It would be interesting to try to rationalize, in the Pierce-Bernheim sense, rationalize, get an optimal debt structure of the issuing of the 520s. Okay, so here's decompositions of wartime revenues. So we do exactly the same thing. Show you a picture. Okay, so I'm challenged.
3 more minutes, Tom. Just to
how many
3
more?
more minutes. 3
Great,
more
great.
minutes.
I'll just show you. Here's how we finance the War of 1812. Tax revenue actually went down because the way we raised tax, the war caused us to reduce our tax revenues. Why? Well, we were taxing tariffs. Who was our main trading party? Our opponent in the war. So there's a whole interest here. This is a war in which taxes actually go down. Debt growth grows like anything. Civil War, taxes pay some, a lot of debt, money some. So anyway, so just show you, here's a picture. Here's the logs of the price levels. This bears steering wheel. There's the Civil War, big increase. Look at the green during the war, and then 20 years of a decline. And Franklin Roosevelt knew this picture. And here's World War I. World War I goes like this, and it starts following the Civil War path. And Franklin Roosevelt knew that he knew this graph. His advisors knew this graph. And they didn't want this to happen, and they did some things to arrest it. So there's that picture. Here's returns on portfolios of Treasury securities. And what you'll notice is the World War I and World War II are very different from the Civil War and the War of 1812. So I didn't get to my poisoning story, but anyway, I'll stop here. So that's it. How we paid for 5 wars.
I mean,
that's it.
Just don't know if you want to finish it, just finish it. It's fine. You will have 2 more minutes, so you finish the story.
Okay, I'll give you my poisoning story.
Yeah, you see, yeah, exactly.
Okay, this is looping back to Marco, and then I'll just stop.
Okay.
Because I've taxed your time. Look at this picture. Look at this picture. During this picture, the way the U.S. government financed the the Revolutionary War is we issued interest-bearing bonds, 6%, promising to pay Spanish dollars. We also issued a lot of low denomination called continentals that were not interest bearing IOUs. You could buy one. They're continental dollars. They promised to pay one Spanish dollar, which was, we were in a currency union with Spain, one Spanish dollar after the conclusion of a treaty of peace. So if you read the Constitutional Convention, there's a big discussion about whether or not the government should ever again issue non-interest bearing small denomination notes called money notes. They call them bills of credit. And the sentiment was that no state should issue it. None of the 13 states. It's explicit in the Constitution they can't do it. States can't issue money. And the discussion said it's understood that the federal government shouldn't do it, but we're not going to put it explicitly in law. And the idea is we should never issue those again. So how do you create a reputation so you never issue them? Well, Alexander Hamilton knew how to create a reputation. What he did is for the interest-bearing debt, he rescheduled it and he paid something like between 70 and 80 cents on the dollar. So, and that's from going from 30 cents on the dollar. He paid you to rebuild that reputation. And he said this is why he was doing it. But what did he do to the non-interest bearing debt, the money? He paid 1 cent on the dollar. And it was such an insult, most people didn't even bring that in. And he did that purposely because he said, we're never going to do it again. You go to the War of 1812, and James Madison says, I'm not going to issue this low denomination stuff, and I'm not going to give a low return on it. And he doesn't. And that reputation that Hamilton explicitly created, it wasn't just Hamilton, that's a symbol for a whole bunch of guys. That dominated policy in the War of 1812. And it was a subject of a debate between Grant and Johnson in the late 1860s, and Hamilton prevailed. Kind of a deal's a deal. And that's how that reputation was built. So there's not formal modeling, but there's fascinating stories about, the conundrum is Hamilton knew about, the Gang of Four papers, and he knew about Abreu, Pearson, Sticchetti, even though he didn't know calculus. Figure that. I'm done.
Thank you very much. I'll open now the floor for questions. Raise your hand so that let me see the gallery. Yeah, raise your hand and you can have one. Okay. So let's start with, I see my screen, Manuel first and then Marco.
Hi, Tom.
Hi.
So just what do you think is the right, maybe it's not the good question, but what would be the right model for Alexander Hamilton reputation building? I mean, what's the right framework to think about this? In that early on, if I'll be thinking about private information and government types, that would be the picture I had in mind, and the different types of governments I could be, and then making decisions that I guarantee the public, in the case of financial market belief, and this, is that the right way to go, or it's more like a repeated game? That's what you were saying early on.
So, if you go back, okay, so it's a great question, and so it's not quite, it's not what I think about. It's not much. It's not worth much. Okay, so if you can go read what Hamilton and actually Hamilton. I would say kind of I agree with your kind of tentative suggestion. That's kind of a model of types, and but but it's all, but you could go read what, if you read Hamilton's report on public credit and you read the criticism of it that was made by Madison, they're kind of telling their types, but then they're also they're talking about, you know, Hamilton says, I want to be the type that, yeah, here's kind of the debate. Hamilton says, I'm the type that says that you sign a debt contract, you do your best to support it. And you organize the government. This is the part, you organize the government, so you rearrange the incentives of the whole political system. So there's going to be support to raise the taxes to support the debt. So he takes it for granted, and you're in a regime where R is much bigger than G. So he kind of says that. And then here's what another part of this debate. Here's what Madison says, you know, kind of reading through. Madison says, I agree, except I want to bring in fairness. And he says, I don't want to reward these nasty speculators. These guys you call liquidity providers, they're speculators. And so he says, we have the data to figure out who bought these treasury securities when. So he says, I don't want to make these bearer securities. I want to make these securities that attach to the original guy. And if he resold them, you know, at a sacrifice, I want to make him good. So I'm going to redistribute simultaneously when I'm going to have this information. And I think there was a lot of information there, which Hamilton ended up having and burned. We don't have it anymore. So they're both types, and they're both talking about, but the part that's missing from, you know, so the parts that's missing from the types literature is, okay, so I name the types, I give the private guys a prior, and now I let it roll. And now it's all about, that's all a theory of pretense. You know, the only reason I'm a total scoundrel, you know, I'm the worst guy, but the only reason Carolyn thinks I'm a nice guy is I'm fooling her. You know, that's kind of, it's like but that's, I think they had something else in mind. They wanted to, anyway. Sorry, but.
No, that was good, thanks.
It's a great Minnesota type question because it's about next steps.
Marco, go ahead.
So your picture, I mean, your tables from this time are incomplete for a good reason, because they couldn't be complete for COVID. But you mentioned, you know, this much was paid by bonds, this much was paid by taxes, this much was paid by money. But of course, paid by bonds is, bonds need to be paid at some point. And then the question is, are those bonds going to be paid by future taxes, by you know, future money printing, and essentially inflation and so on? And so you've worked on that in the previous cases when we know. Does that teach us something? Does that suggest that we're going to go down similar paths? What?
I don't know. I don't know. That's a question we want to raise. That's yes. So, you know, the way George concludes those, you know, this is related to Ricardo's calculations. It's related to, you know, it's related to a lot of calculations that people are doing, the IMF's doing. These guys at the IMF grabbed me by the collar and they said, you got to look at our calculations. And they had calculations, they were rosy scenarios. Like everything's going to work out. So it's just a little bump in the debt GDP ratio. You need they say you don't need any tax increases. You just let it run out and inflation is going to come down. It's going to all fit together like a charm. So they have some versions of those equations, you know. You know, I don't know. George and I, you know, put it this way, if I was just going to be a mechanical history person, and I'd say, look, every time you got a crisis like this, you got a permanent increase in the size of the government. This has happened every time. And if you kind of look at what was in Build Back Better, whatever you call it, that was going to be a permanent increase. and somebody was going to have to pay for it. Is that kind of a sensible thing to think? Yeah. But George and I are, we just, because this isn't a forward-looking paper, this is all just, it's like the worst sin that, Refit, Sten, those guys at least had something. We have nothing. We just have these pictures and a bunch of words. So we stop right there and say, you guess. But I think it's a good picture to look at, especially that price level graph. Every month a new price level comes up. George Saul sends me a new figure. He's really happy about it, but I'm a retired guy holding government bonds.
Let's have the last
That's
question.
what tips are for.
Yeah. Ricardo, let's have the last question and,
Oh, sure. If you have time, because
I mean, we're a little bit above time, but one more question.
It just follows exactly what Tom just said. So the price, as you noted, I'm struck by the fact that last year we had this big surprise inflation, which in many ways is like amazing. Charlie Kehoe or even Lucas Stoke, you had an increase in debt. It's optimal state continues to have a surprise inflation for 1 year to inflate a little bit of that. It's part of optimal tax policy in some ways. But then, of course, once you can do that one, you get the unexpected, but then you should get now constant inflation, or at least you get no benefit from inflation from then onwards, because then it gets incorporated into any expected inflation would show up in the nominal interest rates and not really matter. And so kind of the question is, if the central banks now go back to an inflation target, then in some ways, this last 12 months seem like really close to optimal policy, where we just had a 1 year burst of the CPI, and yep, that's what you should do when you have a big increase in spending, and then no more. But if you go back in history in your pictures, going to your CPI one, it didn't quite work that way, right? I mean, we had the 1 year of unexpected and then became a few years of expected inflation with no benefits on inflating the debt. Or am I over-interpreting? But you see where I'm getting at, like this is a combination of unexpected and expected.
No, that's what, okay, this is exactly the kind of observations and follow-ups that George and I want to happen. Because these pictures, getting these pictures actually to line up with an existing theory, there's timing questions. It's your thing's kind of in the spirit. And yeah, so actually, if you look at the Civil War, the story is like this. You gave, is this a victory for Lucas Stoke Cherokee, or is it a during the war you gave really crappy returns. After the war, when there's kind of like no shocks, then you gave a whole string gradually of very high returns. How does that line up? You put your finger on it, and I'll just say I don't know. There's there's so much in macro. There's so much that we don't know. We have. There's anyway. Anyway. So what you're working on is the real problems.
Thank you. I think it's time to close it. So there is a breakout room. Tom, do you have time? Do you want to continue giving answers to questions? Because I can open a breakout room for you. But if you don't, it's okay.
I think put it this way. I think I made people suffer. And also just to defend myself, I still remembered how to write down Hamilton, Jacobi, Bellman equations. So I just want to say.
Excellent. Okay, there will be a breakout room only for me. So thank you so much.
Tassos, we would like to thank you for organizing and Chetel.
I also want Chetel to talk. So thank you for participating and coming here, and speakers, discussants, audience. And I'll give the floor now to Chetel, who wants to thank you as well. And please join the breakout room if you have questions about the paper.
All right, I'll be super quick. Thanks to all presenters and discussants. It's clear from this that debt and fiscal policy and monetary policy, by the way, are exciting topics to work on, especially thanks to Tom. As always, inspiring and thought-provoking. The only complaint I have is that I think we should have started with this because there were so many ideas that came up. That would be good to have a conference after this, but we can do that next time. Tom, one important message of Tom is that we can learn a lot from looking at the US history. I think that in the spirit of Barrow, we can also learn a lot from the panel of countries in the world. And I think perhaps we should do that, even more of that than we've done so far. The last thing is, there's one issue we haven't covered much. The political economy of debt and fiscal policy. So what is that? Well, there's a huge conflict, huge conflicts on debt, say between the young and the old, between left and right, etc. So if you look at, for example, OECD countries, there's a very strong pattern that right-wing governments, center-right governments, that tend to increase the debt, lower the taxes, and over time have less spending. Whereas left-wing governments does the opposite. They tend to lower the debt, increase taxes, and increase spending gradually over time. Well, we can look at that in future work. Thanks, everybody, and let's have a good weekend, and let's go to the breakout room of Tassos.
Thank you all.
Thank you all.